Hi student, welcome to Manifested Online Classes. My name is Joseph Kemani. In this session, I want us to look on a subtopic number 2 in topic number 3. Topic number 3 relates to the preparation of financial statement of various different entities, and in this particular class here I want us to look on how the professional firms prepare their financial statement. So first of all, what are professional firms? These are those particular firms which are formed in order to provide some professional services to their client. And good examples of professional firms include what you refer as the accounting firm, an auditing firm, law firm, and so on. Those are good examples of professional firms which provide certain professional services to their clients. Now, at the end of the year, or once the year comes to an end, definitely the owners or the partners of such professional firm must determine how their firms are performing, and also their financial their financial position. That's why it is important for these particular firms to be able to prepare their financial statement. And therefore, our main interest as far as this particular topic is concerned is to discuss, or basically we're going to look on the financial statement which the professional firms are or basically which professional firms do prepare. But before we do that, we can say that professional firms are those firms established to provide professional services to their clients, professional services to their clients. So what are good examples of a professional firm? So examples include number one, we have an accounting firm. Number two, we have an audit firm. Number three, we have a law firm, etc. So these are good examples of professional firms which are established to provide certain professional services to their clients. Now, what you have said is that the partners, or basically the owners of this particular professional firm, definitely they are interested with performance of their business and also the financial position of their firms. And that's why it is important for these particular professional firms now to prepare the financial statement. But before we look on the various financial statements which are prepared by professional firm, I want us to define some terms here. We look on the definition of various terms. Definition of terms. So some of the terms we need to define here. Number one is something called a profession. A profession. So when talk about a profession, generally we say that this is a recognized field of study which involves some training and also some examination by a certain professional body. So therefore, a profession is a recognized field of study. So therefore, you can say that this is a recognized Yes, so therefore a profession here we are saying is that recognized field of study, and which involves some training and also some examination. In this particular examination, we are saying it is administered by a professional body, e.g. what? A Kasneb. For instance, for you to be able to set up maybe something like an audit firm, to establish an audit firm, or maybe an accounting firm, definitely you must be a qualified accountant. So for you to be a qualified accountant, you need to undergo through some training. You need to attend a college which is offering some professional courses such as CPA, such as ACCA. You go through that particular training, and by the end of the day, you have now to sit and pass a certain what? Exam, which is administered by a professional body, e.g. Kasneb, e.g. ACCA, and so on. That's why we are saying that when talk about now a profession here, it is that particular recognized field of what? Of study. So the other term which we also need to define here, as far as the professional firms are concerned, is something called the cost charged to the client. Cost charged to the client. When talk about the cost which is charged to the client, in other terms, this can be referred to as the fees which has been earned. A professional firm, we are saying, by the end of the day, provides certain professional services to who? To the client. Once a professional firm has provided those particular services, the client will be charged. The client will be charged some amount because a professional firm incurred some cost in terms of providing those particular what? Services. So therefore, you can say that this is the fees. This is the fees charged by a professional firm. Charged by a professional firm to its clients, for services rendered, for services which have been rendered. For services rendered. Anytime a professional firm provide certain services to the client, automatically those particular clients will be charged a certain what? A fee. And actually, this particular fee which is charged by a professional firm, this is the main source of income as far as these particular firms are what? Are concerned. So the other term we also need to define here is something called a client account. A client account. When talk about the client account, this is basically an account which is prepared by a professional firm to record all the transactions relating to the client. For instance, money which has been received on behalf of the client, and maybe any disbursement or any payment which has been made on behalf of who? Of the client. All those particular transactions which now relate to the client, they are recorded in this particular what? Account. So this is an account which records all transactions relating to the client, relating to the client, relating to who? To the client. Any money which has been received on client behalf, and also any payment which has been made on client behalf, all those particular transactions will be recorded in that particular what? Account. So the other term we also need to define here is something known as WIP, work in progress. Work in progress. So what is work in progress? Work in progress basically refers to the services which are rendered to the client. These are those particular services which are rendered to the client, but when the year is coming to an end, those particular services will not have been completed, assuming you have a professional firm, like maybe an audit or an accounting firm. You have gotten a client, or maybe you have a client and you're providing certain services to that client, but when the year is coming to an end, you have not yet completed those particular services. So meaning that because you are yet to complete those particular services, it means that you have not invoiced to your client, you have not sent an invoice to your client for the client to be able to pay for those particular what? Services. So therefore we say that this is still work in progress, work which is still going on when the year is coming to an end. So we can say these are services Yes, so therefore these are those particular services which are provided to a client but not completed at the end of the year. And therefore, because this work has not been completed, then we have said the professional firm will not have invoiced the client for the client to be able to do what? To pay. Meaning that this particular work in progress, when a professional firm is preparing a statement of financial position, it is treated as a current asset. Services which have been provided, but because they are not fully completed, the client has not paid for them. It is basically like an accrued income, which should be treated as what? As a current asset. So the other term we need to define here is something called disbursement. Disbursement on client behalf. Disbursement on client behalf. When talk about the disbursement on client behalf, this refers to any payment which has been made by a professional firm on behalf of the client. Any payment by a professional firm on behalf of the client. Yes, any payment by a professional firm on current what? Behalf. And therefore, this particular payment which has been made by a professional firm on current behalf, automatically the professional firm expects to recover the same from the client. So this amount is recovered from the client. Recovered from who? From the client. From the client. Yes, so therefore these are basically some of the terms which you need to, or which you must be able to define as far as the professional firms are concerned. And think from there we can then proceed and look on the financial statement prepared by a professional firm. Financial statements prepared by a professional firm. A firm include what? We have two main financial statements which are prepared by professional firm, and those particular financial statements include: one, the income statement. We have the income statement. So the income statement, in other terms, is also known as statement of profit or loss. Statement of profit or loss. And number two, we have the statement of financial position. Statement of financial position. So therefore, any professional firm at the end of the year must prepare those two financial statement: income statement or statement of profit or loss, and the statement of financial positions. The statement of profit or loss, that is income statement, and the statement of financial position. So let's start by looking on what is a statement of profit or loss. Statement of profit or loss, and why these financial statement is prepared. Now, a statement of profit or loss, or an income statement, this one is prepared to determine the performance of a professional firm, to determine whether a professional firm operated at a profit or at a loss. And therefore, this income statement is prepared to compare the incomes of a professional firms with the expenses incurred by a professional firm during that particular financial year. So therefore, you can say that this is prepared to ascertain the performance. Ascertain the performance of a professional firm, firm. On the other hand, we have said it compares incomes and expenses. It compares incomes and expenses of a certain financial year, and automatically the difference between now the incomes and expenses here is a profit or a loss for the year. A profit or a loss for what? For the year. So let's look on the format, how we prepare the statement of profit or loss. Format of statement of profit or loss. And this one is prepared for a certain year, for the year which ended on a certain date. On a certain date. Remember, we have said that in preparing the income statement, generally what we do, we compare now the incomes of a certain financial year with what? With now the expenses for the same financial year. Equally, when preparing this statement of profit or loss, we prepare it using a vertical format. So here we start with the incomes. And for the incomes, first of all, we start with the cost, which was charged to client. Cost charged to client. Remember, in this case, we have said cost charged to the client is the same with the fees which was charged to the client. A professional firm, after providing certain services, it will charge a client some fee, which is basically the main source of income. And then now to this, there is something which we add here, which is known as the crossing work in progress. Crossing work in progress, this is like the accrued income at the end of the year. These are those particular services which will have been provided when the year is coming to an end, but because those services are not fully completed, the client has not paid. This is like an accrued income at the end of the year. Add it to that figure, and then to this you less opening work in what? In progress. Opening work in progress. So and then whatever you get here is the net cost charged to client, net cost charged to client. And then now to this we add any other income. We add any other income, e.g. investment income. If a professional firm is having any other income, we come and we add it there. And then what we do, we get the total income. We get the total incomes of that financial year. To this now total incomes, we proceed and we less now the expenses. So some of the expenses which may be incurred by a professional firm will include things like the salary to staff, expenses, we record them in the first column, things like depreciation on PPE. These are tangible and current assets which are owned by a professional firm. Things like furniture and fittings, motor vehicles, and so on. Things like rent, ETCs, and maybe things like stationery and printing. These also are a common expense which may be incurred by a professional firm. So we get the total expenses, we take them to the last column, and we deduct this from the total incomes. Whatever you get here is the profit or the loss for the year. For the year. So automatically if you get a positive figure there is a profit, but a negative figure there is what? Is a loss. So that is how a statement of profit or loss or an income statement is prepared by a professional firm. Then let's look on how we prepare now a statement of financial position. Number 2, we have a statement of financial position. So when talk about the statement of financial position, this is a statement of asset, liabilities, and what? Capital. So we can say first of all that this yes, so it is a statement of assets, capital, and what? Liabilities. This statement of financial position will be prepared to record these items, to record this particular item. On the other hand, when a statement of financial position is to be prepared, it is prepared based on something known as the accounting equation. We can say it is prepared based on accounting equation. So the accounting equation basically is a fundamental equation in accounting. Is a very important equation in accounting. In fact, the concept of double entry is based on this particular equation there. So this equation states that assets are equal to capital plus liabilities, are equal to capital and what? And liability. So let's look on the format. How do we prepare this statement of financial position of a professional firm? Statement of financial position. Position is at the end of the year, because this one we have said is prepared at the end of the year to show the asset, the liabilities, and also the capital of a professional firm. Always we start by recording assets, and asset we classify them into two, non-current and current. So here we start by recording current assets, that is non-current assets, and in this case we just need to have a single column there. So some of the non-current assets which may be owned by a professional firm may include things like furniture and fittings, things like motor vehicles, things like maybe investment property, etc. You come and you record all those particular assets here. It is also important to note that when recording the non-current assets there, we record them at their net book value. So to compute the net book value of this particular asset, we take their cost minus the accumulated depreciation at the end of the year. The cost minus the accumulated what? Depreciation at the end of the year. Then from there we proceed, record the current assets. So for the current assets, these include things like cash and bank balance, and this cash and bank balance will be the cash and bank balance in, first of all, something known as the current account. Mostly the professional firms operate two different accounts, an account or a bank account known as a current account. Current account is whereby money belonging to the current, any money which has been received on behalf of the current will be deposited, and then another account which is known as office account. Office account is a bank account whereby money belonging now to the professional firm is recorded. So we have cash and bank balance, and then we have things like the crossing work in progress. Crossing work in progress is still a current asset. We also have disbursement on current behalf. Remember, you have said disbursement on current behalf. This is any payment which is made on behalf of the client. A professional firm, by the end of the day, expect to recover that money from the client. And things like the receivables. The receivables, any amount of money, maybe which is not yet paid by the client. And then we get the total asset here. We get the total asset. So after getting the total asset, we double underline that because now we are through with the first part of our statement of financial position. And then from there we proceed and record capital and liabilities. So we start here by recording capital. Then to this capital we add or minus, plus or minus the profit or loss for the year. So a profit is added to that capital, whereas now a loss is deducted. Also, if you are given drawings basically refers to any amount of money which is taken by the partners of a professional firm for their personal use, and then what we get here is the net capital. Net capital basically is the capital at the end of what? Of the year, at the end of the year. So then from there we proceed, we record liabilities. But for liabilities here, we start by recording non-current liabilities. Non-current liabilities, these may include things like bank loan, those particular liabilities which are payable for a period exceeding 1 year. And then finally we record the current liabilities. So current liabilities are liabilities payable within 1 year. This will include things like payables, or basically trade payables. This is the amount of money which is owed to the suppliers. Things like what? Things like money held on client behalf. Money held on client behalf. Money held on behalf on client what? On client behalf, and so on. And then from there we get now the total capital and liabilities. Total capital and what? And liabilities. Total capital and liabilities. And whatever you get here is the total capital and liabilities. Total capital and liabilities. Always this one must be the same with the total asset. Because you are saying that this particular statement of financial position here is prepared based on this equation, which states that total asset here should be equal to capital plus what? Liability. So whatever you get here is the capital and liability. Total capital and liabilities must be the same with what? The total asset. So therefore those are the financial statements which are prepared by the professional firm. We take a break and then in our next session we look on an illustration question as far as the preparation of these particular financial statements are concerned. So see you in the next lesson.
Greetings and welcome to the lesson. The topic is the financing decision. Today we continue with the long-term sources of funds. So far we've covered equity, debt. Today we proceed to the third long-term source known as hybrids, which is also known as hybrid instruments or hybrid securities. And these are financial instruments that combine features of both debt and equity. They possess characteristics of both the traditional debt and equity instruments, providing companies with a flexible and innovative means of raising capital. So in this lesson, we are going to discuss the characteristics of hybrids. We will look at the advantages of hybrids and the drawbacks of hybrids as long-term source of funding. Let us begin with the characteristics, the features, the attributes of hybrids. So candidates, by the end of the lesson, you should be able to explain or outline the characteristics of hybrids, Should be able to highlight the advantages and also the disadvantages of hybrids. So let us begin with the characteristics of hybrids. Now, the first characteristic of hybrids is the blend between debt and equity. Debt, equity, blend. Debt equity blend. Remember, I've just said that hybrids combine both the features of the traditional debt and the traditional equity instruments. And a good example of hybrids is the convertible bonds, the mezzanine debt. We may have hybrids like the warrants, the preferred stocks, and so on. So one characteristic is the debt equity blend. The debt equity blend. Blend means combining. Hybrids combine the elements of debt and equity, which then allows companies to benefit from both the characteristics of both debt and equity. That's first characteristic. 2, fixed and variable returns. Fixed or variable returns. Hybrid instruments may offer fixed returns that are similar to debt or variable returns that are linked to company's performance, which resembles equity. Fixed and variable returns. Then we have convertible features. Convertible. Hybrids, some hybrids have convertible features, allowing holders to convert their instruments into equity shares under predefined conditions. Convertible features. 4, participation in profits. Participation in profits. Hybrid holders may participate in the company's profits, receiving maybe distributions or even dividends based on the company's performance. Based on the company's performance. 5, subordinated nature. Subordinated nature. What does that mean? That means that hybrids are often subordinated to the traditional debt. They are subordinated to the traditional debt, meaning in the event of bankruptcy, the claims of hybrid holders come after the claims of the traditional debt holders. When it comes to prioritization, then hybrids are subordinate to the traditional debt. Then we need to mention perpetual existence. That's a key characteristic of hybrids. Hybrid holders may, the hybrid instruments have no fixed maturity period or date, which provides a perpetual form of capital similar to equity. Perpetual, it gives company perpetual existence. So these are 6 features. Then how about the pros of hybrids. What are the pros of hybrids? Pros of hybrids. The first advantage is flexibility. Flexibility. Hybrids provide flexibility in structuring financing, and companies can tailor the terms and conditions to meet specific needs, blending features that suit their financial strategy. They are flexible. It offers what we call tailored solutions. It offers, this form of funding offers flexible terms. It offers flexible terms and structure, which allows companies to customize by blending the two characteristics of debt and equity. Do you understand? It offers flexibility in structuring financing. And I've said companies can do what? Can tailor the terms to meet specific needs. Flexibility. Number two, it offers diverse investor base. Diverse investor base. Hybrids offer diverse investor base to the company, including both debt and equity investors, as well as those seeking a module or a middle ground between debt and equity. Diversity. Risk sharing. Number three. Risk sharing. How is it an advantage? Hybrid instruments allow for sharing of risk between the company and investors may benefit from the upside potential while accepting a level of risk similar to equity shareholders, equity holders. 4, it offers what we call enhanced capital structure. Enhanced capital structure. Enhanced capital structure. The capital structure is enhanced. The use of hybrids contributes to a more diversified and resilient capital structure, which optimizes the overall cost of capital. Then we have convertible options. Convertible options. How is this an advantage? Now, convertible hybrids provide the option for investors to convert their instruments into equity, which allows them to participate in potential capital appreciation. Convertible options. So these are 5 advantages. We will close the lesson by discussing the cons of hybrids. The cons of hybrids. The disadvantages of hybrids. The first obvious disadvantage is in relation to complexity. You understand? Complexity involves complex documentation, complex documentation, and That is a disadvantage, including negotiation, complex documentation and negotiation. Now, structuring and issuing hybrids may involve complex legal and financial considerations, which may require specialized expertise and higher transaction costs. That is a disadvantage. Complexity. It's complex in structuring these instruments. The hybrid structure can be complex, which can make it also challenging for investors to fully understand the terms and risks associated with the instruments. Complexity. Cost of interest rates, number 2. Cost of interest rates. Cost of interest rates. Cost of interest rates. Now, the cost of hybrids, including any fixed or variable costs, may be higher than the traditional debt. Additionally, hybrids are subject to interest rate risks, which affects their pricing and attractiveness. Costs and interest rates. That is a disadvantage. Subordination, from the word subordinate. Subordination. In the event of financial distress or in the event of bankruptcy, hybrid holders are subordinate to traditional debt holders, and that can impact recovery in case of liquidation. So that is a disadvantage from the point of view of the investors. For market acceptance. Market acceptance. The acceptance of hybrid instruments in the financial markets may vary. Do you understand? It may do what? It may vary. And investors' perceptions and willingness to invest in such instruments can influence the success of hybrid offerings. Because remember, we said that these instruments are complex. They are complex. They are not straightforward like equity or debt. There's also the feature of tailoring. Do you understand? So the market acceptance can vary. In the acceptance of the instruments can vary in the market, financial market, which can then affect investors, which affects investors' perceptions and also willingness to invest in such instruments. Market acceptance. 5, regulatory considerations. There are also regulatory considerations, what we may refer to as regulatory frameworks. And these regulatory frameworks for hybrids may also vary, and compliance with the relevant regulations can be crucial, or we can say is crucial. And companies must navigate the regulatory requirements when issuing hybrid instruments. Hybrids also are subject to covenants, which could be restrictive. Let me say covenants and restrictions. Covenants and restrictions. Now, similar to debt, hybrid agreements might impose covenants which can then restrict financial activities or future funding of a company, thereby limiting operational flexibility. Remember, we say that hybrids is a source of fund that combines both the debt and equity characteristics. It's a debt equity blend. So this feature of debt in relation to covenants and restrictions. And I've said similar to debt because some hybrids may take the form of debt, some features of debt, and one feature is having restrictive covenants, which might impose restrictions, financial restrictions, which may affect the operational flexibility of an organization. That is a disadvantage. So these are 6 drawbacks, 5 benefits, 6 characteristics. Characteristic number 1, hybrids. A hybrid instrument is a debt equity blend. We have fixed and variable returns for those who invest in such instruments. These are returns, it can also be costs on the part of the company. It has convertible features. We've seen that there are some convertible bonds that can be converted into equity based on agreed terms and conditions. For participation in profits, hybrid instruments or hybrid holders may enjoy participation in profits just like the equity holders. Number 5, subordinated nature. When it comes to prioritization, when the company is being liquidated, then hybrids are subordinate to debt holders. Hybrid holders will be subordinate to the debt holders. Then the source also gives the company perpetual existence. They do not have maturity period like debt. These are 6 characteristics. Then the first benefit is that of flexibility. Number 2, hybrids give the company diverse investor base. There is risk sharing. We also have enhanced capital structure and convertible options. Disadvantage number 1, complexity, cost of interest rates, subordination, market acceptance, regulatory considerations, covenants, and restrictions. Now, candidates, in summary, you can say that hybrids offer a unique financing solution by combining both the features of debt and equity. They provide companies with flexibility. They provide companies with the ability to tailor financing structures in order to meet specific financial needs. But on the other hand, the complexity of hybrids and market acceptance are factors that require careful consideration when incorporating them into the company's capital structure or in the company's long-term funding strategy. And that brings the lesson to an end. I'm going to give you an assignment, 3 questions. Number 1, what are hybrid financing instruments and how do they combine elements of both equity and debt? Number 2, in what situations might a company choose hybrid financing over traditional equity or debt? And what advantages or disadvantages does it offer? 3, how do regulatory frameworks and market conditions influence the attractiveness and feasibility of using hybrid instruments for financing? These are 3 questions. Attempt the questions before coming to the next lesson, where we are going to study the characteristics, the disadvantages, and the advantages of leasing finance. Lease finance. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, a practitioner within the financial services industry in Kenya. We are learning about equity portfolio management. The focus of today's lesson is equity index weighting schemes. In today's lesson, we are going to learn about the types of indices that exist within the equities market. Thereafter, we're going to analyze the biases of those index weighting schemes. So to jumpstart this topic or this lesson, we are going to analyze the types of indices. Now, types of indices. The first type of index that exists is price-weighted index. Price-weighted index. There. Now, under the price-weighted index, we can say the following. We can say refers to the arithmetic average. Arithmetic average of prices in the index. Price-weighted index refers to the arithmetic average of prices in the index. Build on this explanation and say that it adds market prices. Adds market prices of each stock. Adds market prices of each stock in the index, then divides in the index, then divides the total by the number of stocks, by the number of stocks in the index. So we're saying that it adds market prices of each stock in the index, then divides the total by the number of stocks in the index. Now, we do not need to do an example of the price-weighted index. This has already been covered in the new unit that is called Introduction to Finance and Investments. And so if you want to see how we can be able to compute the price-weighted index, please refer to the Manifested e-learning platform unit called Introduction to Finance and Investments. Here, we just need to build on equity portfolio management types of indices, and then we try and assess and analyze the types of biases that are there on each index. Number two is market capitalization weighted index. Market capitalization weighted index. This is also called a value-weighted index. Under this price-weighted index, we are only going to consider the prices or the market prices of equity securities. Under this market capitalization weighted index, we will be able to get the price times the number of shares outstanding. So price times number of shares outstanding, like that, gives us market cap, or the value of equity security. Now, let's explain what the market cap weighted index is all about. You can say it sums the total market values, market values, total market values of all the stocks in the index, of all the stocks in the index. It adjusts for stock splits. It adjusts for stock splits. We are saying market capitalization weighted index, it sums the total, sums the total market values of all the stocks in the index. It adjusts for stock splits. So the difference between the price weighted index and the market capitalization weighted index, just to mention in passing, is that the price weighted index only considers, these are the stocks that have actually been listed over here, the market prices, it only considers this column over here. That market prices over there. So we're saying that it is just an average of all the stocks in the index. If the index reaches outside over there, it just sums up all the stocks in this index right over here, and then divides by it divides by the total number of stocks in the index. So this, you add up all of this, and then you divide by all of these values in the index, not on the entire NSE or the entire index or the entire exchange listed securities. No, we're only saying that if these other securities are included in the index, you just add the prices of the securities and divide by the number of prices in the index right over there. Now, market capitalization weighted index, it includes the number of shares outstanding. That. So this is market prices, number of shares outstanding right there, like that. I'm assuming these are the number of shares outstanding. Then you're able to get the market cap. That. So you get this times this, you get y, and so on and so forth, like that. That. So this market cap, if the index reaches up to that point over here, like that now, price weighted index, the index is up to over here, we're only considering this column over here. Now, market capitalization weighted index, also called value weighted index, factors in these values over here. So it sums up all of these like that in terms of market values, and gets the market values and divides by the total market value of, or divides by the total number of securities which have been included in the index over there. So we are saying that in terms of market cap, the challenge is that you could be able to have that security trying to have a large market cap. Rather, I'm saying this security might have the largest market cap over here. Say, for example, in this case in Kenya, Safaricom. Safaricom has got largest market cap. If it has the largest market cap, if the stock price of Safaricom goes down, it means it will impact on the overall value of what? Of the index. There. So it influences the index significantly. So that's one of the biases that we shall be looking at shortly. So that's the difference between market cap and price weighted index. So we can move on to another types of index weighting scheme. Number 3, free float adjusted market capitalization index. Free float adjusted market cap weighted index. There. Free float adjusted market capitalization weighted index. We can say the portion of the firm's outstanding shares of the firm's outstanding shares are available are available for purchase. Outstanding shares are available for purchase. It is adjusted. It is adjusted. It is adjusted for the amount of stock. The amount of stock. For the amount of stock that is actually available. We can further build on this and say that it assumes that the investor has bought all the available shares. Has bought all the available shares. All the available shares. What are we saying about free float adjusted market cap weighted index? The portion of the firm's outstanding shares are available for purchase. It is adjusted for the amount of stocks or stock that is actually available. I'll be able to shortly explain. It assumes that the investor has bought all the available shares. If there are 100,000 shares that are available to the investor, that are available to investors, what we can do is that a portion of this is actually reserved for the founders of that company. So let's say maybe 50,000, not 50,000, maybe say 20,000 shares. So out of this, 20,000 shares are available for the founders. And that means what? It means that only 80,000 shares will be released to the public. What we are saying is that the portion of the firm's outstanding shares are available for purchase. So this is available for purchase by outside investors. These ones are actually reserved to the founders of the company. So we are saying that this index of free float market capitalization weighted index adjusts for the amounts of stock that is actually available. So we are saying that the free float is just the free amount of free shares that is available for investors. So there is always a bias in this free float adjusted market capitalization weighted index, in the sense that what happens is that the index might be adjusted or might be biased upwards because of this issue of the difference between the number of shares issued to the founders, the number of shares issued to the public, and that brings about some upward bias towards the index. Let's move on this other side. We analyze the fourth type of index for equally weighted index. We say that all stock returns are given the same weight. All stock returns are given the same weight. This implies that the index is computed as if as if the investor has an equal investment in each stock, equal investment in each stock, equal investment in each stock in the index, and you can put a full stop over there. We build on this and say that the index must be periodically rebalanced. Index must therefore be periodically rebalanced. Must be periodically rebalanced. Now, what are we saying about equally weighted index? We're saying that all stock returns are given the same weight. And this implies that the index is computed as if the investor has an equal investment in each stock in the index. The index must therefore be periodically rebalanced. Now, once we have learned about the types of indices, we can move on to another subsection that talks about the biases of these 4 types of indices. So biases. Index biases. So we say that number 1, what is the bias of a price-weighted index? So price index, price-weighted index. So we say the major bias is that the price, the securities that have higher prices influence the direction of the movement, of index. The index. The major bias is that securities that have higher prices influence the movement of the index. Of course, in a particular direction, obviously. We talk about movement, we're meaning, or we are referring to movement in terms of direction. So if you have securities such as X, Y, Z, V, this one has got 20, this one has got 50, this one has got 150, and this one has got maybe say something like, for example, it has got maybe say 20 or 19, maybe 10, like that. So these are the index constituent companies, X, Y, Z, V. We're saying that the major bias is that securities that have higher prices, this one, is the one that is going to dictate the movement of the index. So if this one increases from 150, and they are saying maybe at the end of the month end, we're saying now instead of 20, it goes to 17, it goes to 55, and this one goes to maybe say 120, like that, and this one remains around 11, like that. This is the one that's going to dictate the movement like that. So the index is going to move down generally, even if this stock moved up. Yes, you can see this one moved up from 50 to 55 at the end of the month. This one, because it has moved down to 120, this is the one that is going to dictate the movement of the index. That is the major bias of price-weighted index. Let's move on to the next one. Market capitalization weighted index. Because the market capitalization weighted index talks about the market caps. So number 2, market capitalization weighted index. Consistency, yeah. So market capitalization, we still have that example over here, X, Y, Z, V. Here the prices are 20, 50, 150, 10. So we have to get the market cap by multiplying with the number of shares outstanding. Number of shares. This is the market price. Market prices. So number of shares, maybe it is 100,000. This is maybe say 200,000. This is maybe say 100,000, and so on and so forth. This one is maybe 50,000, like that. So the market cap has to be determined. And how do we get the market cap? Market cap, this times that. So 20 times that is 2 million. This one is 5 times 2 is 10. Is 10, and then 1, 2, 3, 4, 5. That's 1 million. This times that, we're saying is 150. 1, 2, 3, 4, 5. As you can see, the impact. Then this one is going to be 10. 5, sorry, pardon me. 5, 1, 2, 3, 4. 500,000. So we're saying that this market capitalization weighted index is impacted more based on the one that has got higher market cap. You can clearly see Z down over here is the one that has got the highest market cap. Now let's see the impact. Now, just the same way as we had done under the price weighted index, let's see the impact if the prices change to the values over there. So you're seeing that this you're getting is 20, like that. This is 5 times 2 is 10. Is 10, and then we add 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6. So this one should be 10, like that. 5 times 2 is 10. It should be 10 million. Should be 10 million, pardon me, for that error. Pardon me for that error. Should be 10 million, like that. So we are saying what? We are saying that the one that has got the highest value over here is the one that has the greatest impact, right there. So what is the bias over here? The bias right over here, clearly you can see, is that if this one moves now to the prices are, so end month, in terms of value. So we have 17, 55, 120, and 11, like that. So this one, so we just multiply, of course, times the number of shares outstanding. So this is the one that is changing, the market prices. So the ending value is going to be that price right over there. So we're saying we need to have the following. We'll get 17 times 100,000 to 1.7 million. So value 1,700,000, like that. Then the next one we are saying is going to fall to 55. We are saying it's going to be 11 million over here, like that. And then this one we are saying is going to be 100,000, and it's going to be times 120. It's going to be 12, 1, 2, 3, 4, 5, 6. And then this one is going to be 50,000 times 11. Is it 11? Yes, it's 11. It's going to be 550,000. That. So what are we saying? we are saying that this is the one that has got the greatest value and is the one that is actually going to dictate and the movement of the index there. So the bias, we can say, the bias is that the value that the security that has got the highest value or highest market cap is the one that actually dictates the movement of the index right there. So we can just indicate that in writing. So I can write that over here. We can say that the major bias in this index weighting scheme is that the security with the highest market cap dictates the movement of the index. The major bias in this index weighting scheme is that the security with the highest market cap dictates the movement of the index, as I have just demonstrated. Let's move on so that you can be able to see the free float adjusted market capitalization with index, the biases. Free float adjusted market capitalization weighted index. Under free float, we are saying that based on the explanation I'd given, that you could be able to float 100,000 shares. But in the arrangement, you find that 20,000 are given to the founders, and maybe the balance 80,000 is floated to the investors or the available investors over here. So what is the bias here? The bias is that this the index could be adjusted or could be inclusive of the free float, and sometimes this 80,000 could even surpass the 20,000, and maybe say that we're saying that the number of shares that could be determined could even be slightly more, like more than the 80,000 that is actually there. So we're saying it could be 80,000, or sometimes it could even be 90,000, which factors in the free float, especially more so when the founders of this weighting of the index decide to actually release some of the shares to other investors. We're saying that that is going to be a significant bias thereon. What am I saying? The bias under free float adjusted market capitalization index is that the index, which is formulated based on the available shares to the investors, could be adjusted upwards, especially more so when the founders actually decide to release some of the shares to the market there. So that is the major bias. We're saying that the major bias of this index weighting scheme is that the free float shares could increase following the release of shares that had been shelved. Release of shares that had been shelved by the founders. That's the major bias. The major bias of this index weighting scheme is that the free float shares could increase following the release of the shares that had been shelved by founders. The fourth type is the equally weighted index. Equally weighted index. Under equally weighted index, we had said that all stock returns are given the same weighting. And so we're saying that small cap stocks are the ones that could be able to have a major impact on the equally weighted index. We're saying the small cap stocks are which ones? So these are securities which are listed on the exchange, those ones. The number of stocks, the number of prices, so prices are indicated right there beside each of those stocks. The number of shares are also indicated. So the market cap is provided. So you get these values over here, X, 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 and so on and so forth, and like that. Once we have this, we are saying we can arrange this market cap in descending order. In descending order. There's a button in Excel that is indicated like that, like that. Sort. Sort. So we arrange it based on descending order. Descending order means that you start from the largest over here, you move down to the smallest. So what happens? So we're saying here you'll have the high cap or large cap. Let me say large cap. Cap stocks. And here you'll have small cap stocks. So in an equally weighted index, the weights are assigned, the weights of the returns of the securities are assigned equally. And so we are saying that the major bias of equally weighted index is the fact that small cap stocks tend to have more magnitude onto the equally weighted index as compared to large cap stocks. So we are saying that the index under the equally weighted index is computed as if the investor has an equal investment in each stock. This index must therefore be adjusted periodically for, must be rebalanced periodically. So these ones are the ones, or the stocks which are maybe from right over there are the ones which will have a major impact on index. And we can say something on that note. So we say that the major bias of this index weighting scheme is that small cap stocks will impact on the index due to the fact that small stocks with small values, that stocks with low prices or low small shares outstanding will will impact or not impact, will tend to magnify the index returns. Magnify the index returns. So we're saying that the major bias of this index, this should be small. Major bias, pardon me, major bias of this index, the major bias of this index weighting scheme is that small cap stocks will impact on the index due to the fact that stocks with low prices or small shares of outstanding will magnify the index returns significantly there. And that said, this brings us to the end of today's lesson. I have an assignment for you. The assignment says, moving over on this other side, saying that assignment explain equity index weighting schemes. Number one, explain the equity index weighting schemes. Equity index weighting schemes. And number two, we say analyze the biases. Analyze the biases of the above above equity index weighting schemes. Explain the equity index weighting schemes that you know, and analyze, number two, the biases of the above equity index weighting schemes. This brings us to the end of today's lecture. Like I've already said, thank you and God bless you.
This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15, and 16 amounted to 100,000, 75,000, 50,000, and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information number 1, because we are given the balance sheet as at 31st December 2012, which obvious the balance sheet has the capital, the assets and liability. So if you look at the capital, we cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one, the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter, Chawawa, capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017. As per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with the total assets. So first of all, we'll bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, 1,000. Then motor vehicle, 500. Then we now bring forward the point number 3, trade debtors, 173, 190, 28, 230.5, 253. Bank balance, which we have 109, 194, 281, 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand, $10. Stock, 255, 302.5, 332.5, 366, 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account, $300, $900, $100, $725, and $750. With no other, we'll get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan. So in additional information number 5, we were told that there was a payment of $250 every year. So here, 1,000 minus 250 give us 750. Minus 250 again, 500. Minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors, which you have to 30, 241, 253, 272, and 291.5. And then we can get the total. So 2,000 plus 1,000 plus 500 plus 173 plus 109 plus 10 plus 255. 255 plus 300, giving us 43, 47. We do the next one, 2,000 plus 1,000 plus 500 plus 190 plus 194 plus 10 plus 302.5 plus 900. 5096.5. The other one is 2,000 plus 1,000 plus 500 plus 208 plus 281 plus 10 plus 332.5 plus 100. Have 44, that 1.5. The other one is 2625 plus 1500, this is already 1500, plus 230.5 plus 281 plus 10 plus 366 plus 725, giving us 5737.5. Next is 2625 plus 1500, that is the 1500 plus 253 plus 10 plus 402.5 plus 750, 5540.5. The other one will be 750 plus 230, 980. Then this will be 741. This will be 503, 272. And then this one is 291.5 plus 32, giving us 323.5. Now we can get the capital at end of the year. That is assets minus liabilities. So it will be 43, 47 plus 980 plus 980 minus, sorry, it should be minus 980, giving us 3367. Next is 50, 96.5 minus 741, give us 4355.5. The other one is 44, that 1.5, and then minus 503, that 928.5. The other one is 57, that is 7.5 minus 272, giving us 5465. 5465, 65.5. Then 5540.5 minus 323.5, giving us 5217. Then now we less capital at the start of the year. Which for the first year we have to bring the capital that was there, which was 2800, the one in additional information number 1. Now for this one it will be this one, 3367. This one will be 4355.5. This one comes here, 3928.5, and this one 5465.5. So we'll get the net accounting profit. So we start with this, that figure minus 54 65.5, giving us negative 248.5. This one, 54, 65.5 minus 3928.5, 1537. The next one is 3928.5 minus 4355.5, 43. $43.55 $43.55.5, giving us negative 427. The next one, this one, 43.55.5 minus 33.67, 988.5, 33.67 minus 2800, 567. Now, this will now add non-allowable expenses, as per the question. Number 1 does not have an expense. Additional information. Number 1 was a balance sheet. Number 2 was an extension. Number 3 were assets and liability. Number 4, he withdrew goods worth 5,000 per annum from the business for personal use. So we have drawings. Drawings are not allowable expense, which we are told each year was 5,000. Since they are shillings 1,000, it will be 555. Number 5, the principal repayment on each mortgage loan was 250 per annum from 31st December 2017. That doesn't have any issue. It's not an expense. It's a loan that was being repaid, but there was mortgage interest. Mortgage is used to construct a residential house. So the interest on mortgage is not allowable because it's not for business, it's for residential. So mortgage interest which we are told it's 100, 75, 50, 25. This didn't have anything. The number 6 is about the saving account and interest earned. That's an income, not an expense. Number 7, there is living expense. Living expense are not allowable. $300, 400, 450, 500, and 600. And wear and tear, that's now, wear and tear, remember, is a capital allowance. Capital allowance. So an unallowable ends there. We now less capital allowance and non-taxable incomes. And we start with capital allowance. We said capital allowance is the wear and tear. So capital allowance or WTA. So we deduct, we have 155.5. We have 130. We have 109. And then 73, 157. The only thing that remains is the non-taxable income. So we continue here 2013, 2014, 2015, 2016, 2017. So we now look for the non-taxable income. There was only one income in the question. In number 6, interest earned from saving account. That, if you look at what we said when we were looking at the taxation of the business income, interest earned by an individual from a bank is a qualifying interest. Withholding tax is final. So that we need to remove because we should not be taxing it again. So interests from bank saving account, which we have 300, 900, 100, we have 725, and we have 750. The interests are 25. These are saving account. We are looking at the interest, 75, 90, 70, 60. And 60. Now, with nothing more, we can get net taxable incomes. So we add them. So we'll start from here. 567 plus 105. This actually 405 plus 405 minus 155.5. And then minus 25. 791.5. Next, 988.5. And then this is 80, 480 plus 480 minus 130 minus 75. 1263.5. Next, negative 425.7. 427. And then this 500, 505 plus 505 minus 109 minus 90. Negative 121. Next is 1537. This 525, 530, so plus 530 minus 73 and also minus 70. It will be 1924. Next, negative 248.5. That is negative 248.5 plus 605 minus 157 minus 60. We have 139.5. Yeah, so that is how you determine the taxable income using the capital statement under the tax investigation. So that brings us to the end of this topic. Until I see you in our next the next lesson, see you then. Have good time. Thank you.
Hi there. So welcome back to Manifested Online Classes. So in this session, I want us to look on an illustration question regarding accounting for leases by the lessee. And recall what you have said in our previous session, that the lessee is supposed to recognize two items in his books of account: the right of use asset and the it is what? Liability. So I want us to look on an illustration question here. We look on how we determine those two items, right of use asset, and there is liability. So the question reads, or the illustration reads, on 1st of January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for 3 years period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on 31st of December 2019. Initial direct costs incurred in the lease amounted to 30,000 and were paid by Breakwood Limited. The plant and equipment had a remaining economic usufruct for 5 years at the inception date of the lease. The lease contract did not contain any purchase option for the lessee. And then you're told Breakwood Limited can borrow at an interest rate of 10% per annum. So we are required to analyze the accounting treatment of the above lease transaction from the inception for 3 years period of and there is what? A contract. So basically, what you're told in this particular illustration here is that the company which is called Breakwood Limited leased an asset. So what that means that Breakwood Limited is the lessee, is a company which has been conferred, is the company which has been given the right to do what? To use an asset for a given period of time. And I think in this case, we are told that this company was given the right to use the asset for a period of 3 years, from 1st of January 2019 to or basically up to the end of the 3rd year. So what you have said is that once a company leases an asset, at the inception date of the lease, or when the lease commences, such a company should recognize 2 items. Something we have referred to as the lease liability, and number 2, what we have referred to as the right of what? Use asset. So therefore, let's determine those 2 items. And we are going to start by determining the lease liability, and that is on 1st of January 2019. 1st January 2019, this is the inception date of the lease. And you have said that this is equal to the present value of the lease, or the minimum lease rentals, present value of minimum lease rentals not paid at inception date of the lease, inception date of the lease. So for us to be able to compute this, we have to understand what you're told in that particular question there, that this particular lease commenced on 1st of January 2019. So 1st January 2019, this is the inception date of the lease. It is the date when the lease commenced. So, and you're told the lease is for 3 years. The first year will end on 31st of December 2019, 31st of December 2020, and 31st of December 2021. 31st of December 2021. And we are told that the rent which is payable, and the minimum lease rentals which is payable, is an amount of 500,000, and we are told that the first rent will be paid on 31st of December 2019. What that means is that this minimum lease rentals is payable at the end of each year. Payable at the end of each what? Year. It means that the other minimum lease rentals, or the other rent, will be paid at the end of year 2, and the other one will be paid at the end of what? Year 3. At the end of what? Year 3. So therefore, how do we determine the lease liability? We determine the lease liability by getting the present value of the minimum lease rentals not paid at the inception date of the lease. So in our case here, the minimum lease rentals which has not been paid on this date include this amount, that, and what? That. So therefore, the lease liability is equal to the minimum lease rentals, which is an amount of 500,000, and basically this is like an annuity, is a series of payment. We need to multiply that with the present value, interest factor of annuity, At which rate? At the rate which you are given there. In the last paragraph of that question, you are told that this company, which is Breakwood Limited, can borrow at the rate of 10%. That's what we are going to use for discounting purpose, and basically for the period of 3 years. So we multiply that with the present value interest factor of annuity at 10% forward for 3 years. So therefore, we have 500,000. So we need to get the formula for getting this, where we take 1 minus 1 plus R. Our R in this case is 10%. So this will be 1.1 raised to power n. Our n is what? 3. And then we divide that with what? With R, which is 0. What? 0.1. So basically this is a formula which we use in terms of getting the present value interest factor of annuity. So we take what? 1 minus 1 plus what? Plus R raised to power negative n, and then we divide that with what? With R. So that is now what we are using what? Here. So therefore, let's get that risk liability at the inception date of what? At the inception date of the risk. So let first of all we compute this, and we take 1.1, we raise that to negative 3, and then we deduct that from 1, and then we divide that with 0.1, and then times 500,000, and that will give us a figure of what? That will give us a figure of shillings 1,243,426 to the nearest what? Whole number. So this is now the risk liability at the inception date of the risk. And then what I've said is that once we have determined this particular risk liability, what we need to do is to amortize it. To amortize a liability is to gradually write off the liability, because now this represent the amount of money which now the lessee, that is Breakwood Limited, is expected to pay over the risk what? Term. So therefore, what we need to do before we determine the right of use asset, let's amortize this particular what? Liability. So we amortize that liability by preparing something called the risk amortization what? Schedule. So we need to prepare something called a risk amortization schedule. A risk amortization schedule. Risk amortization schedule. So how do we prepare this schedule? We always start with the years which are ending on 31st of December. So and basically we know that the first year was supposed to end on 31st of December 2019, and then the other column here will be for the risk liability at the start of the year, that is balance brought down. Then the next column which follows here always depend with when the rent is payable. If the rent is payable at the start, the next column should be for the rent paid. If the rent is payable at the end of the year, the next column here should be for the interest. So mean that because our rent here is payable at the end of the year, our next column here should be for the interest. And basically this interest we computed based on the rate of 10%, based on the rate of 10%. And then the other column here should be for the risk rentals paid, or in other terms you can just refer to this as cash paid. Cash what? Cash paid, which now represent the rent paid at the end of each year. And finally we have the risk liability. The risk liability at the end of what? At the end of the year. So that's how we prepare our amortization schedule. Our amortization schedule. So in our case, we have said the first year ended on 31st December 2019. The other year ended on 31st of December 2020. And the other year ended on 31st of December 2021. So what is the risk liability at the start of year 1? So the risk liability at the start of year 1 is what you have determined there. The amount of 1243 426. So then we compute the interest, which will be 10% of this. 10% of this will be 43 or 124,346. 343. 343. And then we know that at the end of year one, how much cash, or basically how much rent was paid. So at the end of year one, the rent which was paid was 500,000. Was 500 what? Thousand. So how do we get then the lease liability at the end of year one? To get the lease liability at the end of year one, we take the lease liability at the start of the year plus the interest, and then we less cash which was paid. So that will give us the lease liability at the end of what? At the end of year one. So we take 1243, 426 plus 124, 343, and then we less 500,000. We less 500,000, and that will give us now a lease liability of what? Will give us a lease liability here of 867, 769. So we can confirm whether that is correct. We take 1 million 243 426 plus the interest 124 343 minus what was paid, which is 500,000. 500,000. Yes, that will give us 867, 769, which now will be the lease liability at the end of year one, and equally that now will be the lease liability at the start of year two. So we compute interest being 10% of that, which will give us 86, 777, and then the cash which was still paid in that year was how much? Was 500,000. So let's work out the lease liability at the end of year two. So we have 867, 769 plus the interest, which is 86, 777 minus 500,000, and that will give us a figure of 454, 546, and then that now will be the lease liability at the start of year 3, 454, 546, and then we get 10% of that, which now will be our interest, which will be 455, 455, and then we less now what was paid. So what was paid at the end of year 3 is what we have there. So and then we get now the lease liability at the end of year 3. So which will be 454, 546 plus 45, 455 minus 500,000, and basically that now will give us what? 0. It will give us what? 0. So that's how we prepare what we refer as the lease amortization schedule. The lease amortization schedule, of which the objective, the purpose of preparing that lease amortization schedule is for us to be able to amortize this particular word, lease liability. And what now the lessee should account for in his financial statement is that this particular lease, or basically this interest which we have here, this one is accounted for as an expense in the income statement of the lessee. Is an expense in the income statement of the lessee, and then this particular lease liability is or is basically a liability. Is what? Is a liability in the statement of financial possession. This one is recognized as a liability, in the statement of financial possession of who? In the statement of financial possession of the lessee. So then next what we need to do is to determine the other item, and the other item we need to determine here is what? Is the right of use asset. The right of use what? Asset. Right of use asset. Right of use assets, and we need to determine the right of use asset at the inception date of the lease, which is the 1st of January 2019. 1st of January 2019. Remember, we have said that we determine fees by adding 3 items. items. One, there is a liability at the inception date of the lease. Remember, you have already determined there is a liability at the inception date of the lease. To that, we add any payment which was made before or at the commencement date of the lease, plus also we add what we refer as any initial direct cost associated with the lease. So therefore, what we do here, we take the lease liability. There is liability at the inception date of the lease, that is on 1st of January 2019, and we already have that figure here, which is 12 43 426, and then to this we add payment made at or before the commencement date of the lease. Commencement date of the lease. Commencement date of the lease. So if you check on this particular scenario which we have here, you'll be able to see that we don't have any payment which was made here. No payment which was made before or at the commencement date of the lease. But if this rent, this minimum lease rentals was payable at the start of the year, then the amount now which would have been paid at the inception date of the lease, or basically before the commencement date of the lease, would be now the rent which was paid at the start of or at the commencement date of the lease. So therefore, in our case here, we don't have any payment which was made before or at the commencement date of the lease. And then to this we add the initial direct cost. So this is any cost which was incurred at the commencement date of the lease. If you go back to the questions here, to our illustration, in paragraph number 2, we are told the initial direct costs incurred on the lease amounted to 30,000 and were paid for by Breakwood Limited. So in our case here, we have some initial direct costs which were incurred on the commencement date of the lease, and which amounted to how much? Which amounted to 30,000. So we add it there. So whatever you get here, we refer to that as the right of use asset. The right of use what? Asset. So let's add these two figures, which will give us 1273 426. 426. That is now the right of use asset at the commencement date of the lease. Then what you have said is that this particular right of use asset then should be depreciated at the shorter of two periods. At the shorter of two what? Periods. So this one should be depreciated. Right of use asset should be depreciated at shorter law of number one, the lease term. So in this case, when talk about the lease term, we are talking of the period of the lease. So in our case, we know this lease is for what? For 3 years, or Roman 2, economic life of the asset. Economic life of asset. So are we given the economic life of the asset in this particular question here? Yes. So we are given the economic life of the asset in paragraph 2, sentence 2, where we are told the plant and equipment had a remaining economic useful life of how many years? 5 years. So we are given the economic life of the asset, which are 5 years. So therefore, what we need to do is to depreciate now this particular right of use asset at the shorter of those two periods. So which period is shorter? The period which is shorter is the lease term, which are 3 years. So therefore, to determine the depreciation per annum, per annum of this right of use asset, we take the amount for initial recognition, which is 1273 426, and then we divide that with 3 years. That will give us now the amount to be recognized as depreciation in each of those 3 years. So 1273 426, divide that with 3, and that will give us annual depreciation of 424,475. So that is now the amount to be recognized as what? As an expense or basically as depreciation in each of those 3 years, in each of those 3 years. And then this particular right of use asset, in each year, it should be depreciated at that particular amount, amount. So therefore, that is basically what the examiner here was requiring. You illustrate how this particular lease will be accounted for that particular period of 3 years. So what you are supposed to do there is to remember that the lessee, the company which has leased this particular asset, will recognize 2 items: the lease liability, and we have looked on how we determine that, and then which you have said should be amortized over the term of the lease. And 2, the lessee, that is Breakwood Limited, will also recognize what you have referred to as the right of use asset, and then that right of use asset should be depreciated over the term of the lease. So basically, at the shorter of those 2 period, the lease term and also the economic life of the asset. So that what is required as far as that particular illustration is concerned. So that brings us now to the end of how the leases are accounted for by the lessee. So we take a short break, and then once we come back, I want us to look on how we or how the leases are accounted for by the owner of the asset, or basically the person who is called the lessor. So we take a short break, and then see you in the next class.
Hi there, my name is Patrick Kamau Kamure. You are a lecturer in Public Finance and Taxation. Welcome to today's lesson. Today, we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are 3 businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side. Equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information: number 1, the following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required, 1, adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we were not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So we'll come here and have the debtors stock receivable. You start with balance brought down here. That's what we said for the debtors. And then jump 4 or 5 lines here where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases. We say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance brought down here for the creditors, and then jump 4 or 5 lines, then have the balance carried down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, Cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partner. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see, the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162. Plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times now weekly for the total, which is 7,200 plus 6,400, and that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now this at the end of the year, what the supplier are owing is 780,000. And then while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side would be now the credit sales here. Credit sales. So we add them 5,200 thousand plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 12,700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,200,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10,812,500. Then we minus the closing stock. closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number one was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10, 8, 12, 500, you minus 620,000. And that gives us 10, 192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20, 562, 500. And that gives us 10, 370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we use it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove, because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get to the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be arriving there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment, which we have 12,800. That will give us how much? This will be 62. 500, we minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense, but it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest, anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000. And we minus from 612, that give us 312. 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest. Motor vehicle expense. Motor vehicle expense is allowable. And we say that is not the cost of motor vehicle. It's the vehicle, expense incurred to run the motor vehicle. Fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses. Where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties. We said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense. But we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses, 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1. The following payments were made in cash from cashes. Motor vehicle expense we have considered. Wages we have. Sundry expense we did. Weekly drawings, those are not allowable expenses. Additional information number 2. Those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember, we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. Number 2. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. discount received. That is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there, we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamila Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 6. 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10, 370,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70,93,500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12, because they were monthly. They were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216, 480. 480,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So, we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is the fifth one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3. The other one, 1 out of 3. So let's minus 70, 93, 500. We minus 480. And also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209,900. 1,000, sorry. And the other one, we can take the 6313,500 minus what we have given this. 6313,500. That will give us 2104,500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000. And then we add 2104, 500, which gives us 2493, 500. And now the total, which will be for 80,000 plus 300, and then we add 63, 13,500, which give us 1793,500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here, and now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Welcome, learner, to our human resource management subject, and we are looking today at Frederick Herzberg's two-factor theory, and we want to look at it in terms of the two aspects presented, two factors presented by Frederick Herzberg. Frederick Herzberg's two-factor theory is also referred to as motivation hygiene theory. Is also referred to as motivation hygiene theory. And in 1959, Frederick Herzberg proposed a two-factor theory, and according to Herzberg, there are some factors that result in satisfaction, while there are some other job factors that may prevent dissatisfaction. So according to Herzberg, the factors which enhance satisfaction should be maintained, and the factors which prevent dissatisfaction should be addressed to ensure that employees are motivated within a working environment. So Herzberg classified these job factors into two categories, and these two categories are hygiene factors. So you have the hygiene factors. You have the hygiene factors and motivational factors. Hygiene factors and motivational factors. And according to Herzberg, within a given environment, there could be some aspects built in the job itself. And these aspects that are built within the job itself, according to Herzberg, these are the satisfiers. And that is what Herzberg proposed, that managers have to be able to find out, organizations have to be able to find out what are these inbuilt factors within the job in relation to motivational factors that may enhance employee motivation, and they can be cultivated and they can be put in place, and workers can be encouraged to be able to perform. So we want to look at the two factors. So we will start with the hygiene factors. Hygiene factors. These hygiene factors that were brought out by Herzberg, the hygiene factors are those that may, in the working environment, if they are not addressed, bring dissatisfaction within that particular setting. And Herzberg proposed that an organization has to address those hygiene factors. And what are some of the hygiene factors according to Herzberg? So according to Herzberg, the hygiene factors in an organization may be things like pay, And when it comes to pay, number one, pay, so this could be pay structures, and pay levels. Pay structures and pay levels. So what Hasberg was suggesting, if an organization wants its employees to perform, then they have to look at the hygiene factors in relation to pay. And in this case, you are looking at pay structures, you are looking at pay levels, you are looking at commensurate pay that should be given to employees depending on their performance. Then the next thing could be company policies, organizational policies, organizational policies and procedures. So an organization has to look at the organizational policies and procedures in terms of the guidelines that are available within the work environment that govern the relationship between workers, supervisors, managers, and how work is done in that particular work environment. So when that is now addressed, then there are also aspects of fringe benefits, benefits. So these ones are the extra perks that are provided to workers. For example, an employee in a given organization could be told if they are in an environment where parking is a challenge, that worker could be having a specific area where they park. So when they come to the work environment, they are able to find ready parking. They don't have to move up and down looking for parking. They could, for example, have good physical working conditions. So physical working conditions, physical working conditions should be looked at. So when it comes to the working environment, physical working environment. So this physical working environment may encompass things like maybe the machines, the tools, the equipment that employees are using. So here, machines, tools should be in good condition. Should be in good condition. So if an employee is working and the machine they are using, the employee is using, and the equipment the employee is using is in good order, then that employee will enjoy even doing that particular work. So when you give employees equipment that are current, modern technology, even that worker will want to come and see how they can also be able to use those equipment. Then number 5, you have status. Employees should be recognized. And appreciated. Recognized and appreciated. So if you have designations or titles, then an employee will feel recognized, will feel appreciated, and this can also help in enhancing that employee's, for example, position. Then you also have interpersonal relations, interpersonal relations, interpersonal relations. So this should be cordial. Cordial relations should be cultivated within a given environment. Interpersonal relations, an organization should ensure that the way workers relate to each other, the way they also relate with managers and so on, the way subordinates and superiors relate, that should be cordial relations. Then you have the aspect of job security. So this could, for example, be given in terms of contracts, stable appointments, stable appointments, among others. So an organization should be able to provide job security, ensure there is work for employees, and that way employees can put in more effort. So this could be some of the hygiene factors which must be addressed within a given working environment to ensure that workers are able to be motivated to be able to work in terms of their areas of operation. Then you have now the second part. That one was hygiene factors. Then you have what you are calling motivational factors. Motivational factors. Motivational factors, or sometimes they were referred to as satisfiers. Motivational factors or satisfiers. So we have looked at the one side. These aspects are not inherent in the job. These are things which are around the job. So Hasberg recommended that in terms of the motivational factors, an organization has to look at the job itself now. The organization has to look at the job itself in terms of how that particular organization is able to work. So in terms of motivational factors, there is the first one, which is recognition. Recognition. So the employees have to be recognized in the organization. The organization, like now, if you have a general manager, you have a maybe plant manager, they have to be recognized within that particular organization, and they have also to be recognized in terms of their accomplishments. In terms of accomplishments, which must also be, which have to be appreciated. For example, an employee has invented some way of doing work that has to be recognized in a function, and if possible, that worker could also be given some reward in relation to that particular recognition, and that one will motivate that worker and other workers to be able to work effectively. And then number two, there is the aspect of sense of achievement. What happens, Lana, human nature is that if somebody does something and there is an element of achievement, right? For example, if an employee is given a target, okay? An employee is given a target, for example, you have got 1,000 acres of land that is arid, for instance, and you put there a team and they are supposed to be able to translate these 1,000 acres into farmland and be able to make harvests from there. So these kind of workers in that kind of a team, they will have a sense of achievement if they achieve this target of translating arid land that is 1,000 acres into arable land that can be able to sustain life and be able to feed people and so on. Then there is the element of growth and promotion. Growth and promotion. Growth and promotion. So an organization has to provide opportunities for advancement. Opportunities for advancement. If workers have achieved, if workers have performed, then these workers should be promoted, for example. So these ones could be, for example, promotion to higher grades. So that will make those employees who have been promoted to move to higher grades. It will make these employees to be able to work hard, and other employees will also want to work smart so that they can also grow in terms of their career expectation, as the case might be. And then it is important that employees within organizations are also made responsible. Responsibilities So we are looking at motivational factors. So if you have a team, for example, if you have a team and you make them responsible for production, for example, responsible for production, so they will set targets, they will bring together their schedules, they will decide when they are supposed to maybe stop the machine and do overhaul. And when they have those responsibilities as a team, if they achieve or if they are challenged to be able to achieve challenging targets and so on, then that particular kind of a group can be able to operate, can be able to be motivated in terms of a team, in terms of the members and so on. Then there is the element of meaningful work, meaningful work. So that work should be worthwhile. Whatever employees are doing should be worthwhile, something they can be proud of. For employees to be proud. Employees should be proud of what they are doing. If they are doing things that are making lives better, if they are doing things that are changing the environment, that are changing the society, they are, for example, producing products that are being used to save lives. They are making products which are used to feed people who are hungry, dress or clothe people, provide intervention measures and so on, assist humanity. So this meaningful work will make it worthwhile, and it is a motivational factor for employees, and it is one of the satisfiers that management has to make sure within a given work environment, employees are motivated. So having looked at now hygiene factors, we have also looked at motivational factors. What are some of the implications of two-factor theory? Implications of two-factor theory. Implications of two-factor theory. So we want Lana to look at what are some of the implications of the two-factor theory. So one, managers and supervisors must create a conducive work environment for effective motivation. Two, employees should be involved in decision making. Number three, why this Frederick Herzberg's two-factor theory is critical. Jobs must be designed. To enhance employee motivation. So what you are saying, Lana, in this point is that if you look at the hygiene factors, these are factors which are outside the job. But if you look at the motivational factors, these ones are factors which are inherent within the job. Then progressive recognition should be made to employees, to encourage motivation. So you have a situation where employees have performed well, and it had been agreed that if you achieve, it is important that you are recognized. So the recognition should be made. And number five, organization should combine intrinsic intrinsic and extrinsic rewards. Extrinsic rewards. Organizations should combine intrinsic and extrinsic rewards in their motivation. So what happens, it is not only the extrinsic factors, intrinsic and extrinsic factors are important. So organizations must seek to strike a balance in terms of how they may want to motivate their workers. And then it's also important, number 6, job enrichment. Job enrichment should be used to provide employees with vertical job loading factors, vertical job loading factors to motivate workers, through challenging tasks. So Lana, these are just some. Job enrichment should be used to provide employees with the vertical job loading factors. So here is where higher level jobs tasks are brought down to encourage employees to be able to perform in a given organization, to achieve that sense of achievement for the meaningful of the work, so that the work is also exciting. So Lana, summary of Frederick Herzberg's two-factor theory. We have looked at Frederick Herzberg's two-factor theory, and we have indicated that Frederick Herzberg's two-factor theory may also be referred to as motivation hygiene theory. It was proposed in 1959 by Frederick Herzberg, and according to Herzberg, there are some job factors that result in satisfaction, while there are other job factors that prevent dissatisfaction, and Herzberg classified them as hygiene factors and motivation factors. We have had a look at some of the hygiene factors, and we have indicated that some of those hygiene factors are pay, where you are looking at pay structures and pay levels. We also have hygiene factors like organizational policies and procedures and guidelines. We also have fringe benefits or extra perks, number 3. Number 4, physical working conditions like machines, tools should be in good conditions to facilitate smooth working. Number 5, status, where we have said that employees should be recognized and appreciated. Number 6, interpersonal relations should be cordial. Number 7, job security should be provided to workers where they are appointed in contracts that are stable. So, Lana, those are some of the hygiene factors. Then when it comes to motivation factors, which we have indicated like satisfiers, number 1, there should be recognition, where employees should be recognized for their accomplishments and appreciated. Number 2, sense of achievement, where workers are given targets that if they achieve, they also feel they have conquered and achieved something. Number 3, growth and promotion opportunities should be provided to workers. Then number 4, responsibilities, where team production could, for example, be encouraged. Number 5, meaningful work should be made available, where workers feel that it is worthwhile to be able to perform those tasks. Then we have also looked at the implications of the two-factor theory, and we have indicated that it has several implications, including, number 1, managers and supervisors must create a conducive work environment. Number 2, employees should be involved in decision making. Number 3, jobs must be designed. Jobs must be designed to enhance employee motivation. Number 4, progressive recognition should be made to employees to encourage motivation. Number 5, organizations should consider combining intrinsic and extrinsic rewards in their motivation processes. And number 6, job enrichment should be used or provided to employees with vertical job loading factors to ensure that workers are able to perform higher level activities, to challenge them and to give them an opportunity to make a contribution and feel that their knowledge and skills have been applied. So before we finish, you have an assignment, learner. Assignment. And your assignment today is assess the application of Hasberg's Frederick Hasberg's two-factor theory in human resource management. Human resource management. So learner, that is your assignment. Assess the application of Frederick Hasberg's two-factor theory in human resource management. So I want to take this opportunity to thank you very much for being attentive in our lesson today. Thank you.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number 1, we have the horizontal structure. Number 2, we have the vertical structure, and also number 3, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in 2 or more in two or more subsidiaries, two or more subsidiaries. So the parent company here is having direct shareholding in two or more what subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary, subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have 3 companies, And A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited. And then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure because the parent company here, which will be or which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary, is referred to as a sub-subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary, or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the sub-subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the sub-subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a sub-subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the sub-subsidiary. Number two is you need to identify the date, identify the date when the sub-subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the subsidiary became a member of the group. And actually the subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the subsidiary. So therefore you can say that the subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the subsidiary. So basically we are saying that the subsidiary will become a member of the group on the later of these two dates. On the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that you're told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. 1st January 2022. Therefore, in this case, we are saying the subsidiary will be deemed to have become a member of the group on the later of the two dates. The later of the two dates, the date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, point number three is regarding the cost of investment. Cost of investment in the subsidiary. Cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. in acquiring the shares of what? The sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the sub-subsidiary. We compute this by taking a cost of investment in sub-subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the sub-subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 80 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the sub-subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the sub-subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the sub-subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, in sub-subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the sub-subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the sub-subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year. So that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the brackets, and we enter. So I think I didn't put open a bracket here. That's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till All Share Index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or variance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That's our beta, 0.0932. And if you are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi students, welcome to another session of Manifested online classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of 2 brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following balance was extracted from the books of the society as at 31st of December 2021. We have a balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued lends, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number one, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 and $115,300 respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you are told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account. That is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura a cooperative society for the year which ended 31st of December 2021. Number one, Safi Brad marketing account showing the profit and loss. Element 2, Mzuri Brad marketing account showing the profit or loss. And part C, statement of profit or loss for the year which ended 31st of December 2021. And finally, statement of financial position. So as far as the first two accounts are required, part A and part B, whereby you're required to prepare the marketing account of the two coffee brands. We're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee brands. And what we are going to do, we are going to take now the sales, which the sales of the two coffee brand, which is given the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1 and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%, then we are going to less now the expenses specifically relating to those two coffee brands. So we start with part A of that particular question. We are required to prepare a Safi brand marketing account, which is for the year which ended 31st of December 2021, 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was 175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate this into Kenyan shillings. I've said we are going to use now the exchange rate when the money was remitted out to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000, then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these two coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we less now the expenses. So first of all, we have now to deduct amount due to members. And basically in this case, we have said the amount due to members is 80%. Amount due to members. That amount due to members in our case, we have said, is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. So what is 80% of 80% of this? 80% of 17,500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, 20% of this. Maybe you can just confirm 20% of 17,500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item in the trial balance, we have the expenses associated with marketing and selling a Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860. And then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300. But this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what you have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 2306. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. To record them here. So we have marketing expenses. Marketing expenses, an amount of 150. And then we have processing materials. Processing materials, an amount of 320. And then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. These are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this is what the cooperative society was supposed to pay to the members. It had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative society. Remember what you have prepared in part A. Part B is prepared to determine the profit from marketing and selling the two coffee brand. So part C, we are required to prepare a statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have two columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. With the expenses, automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before we go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee breads on behalf of the members, we know that from marketing of the 2 coffee bread, there was a profit of 1100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee bread, Safi, which is a figure of what? Of 1100. And then we also have the profit from the other coffee bread, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment, dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, this is like the retained profit at the start of there, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society. And these entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft. All those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans. Members or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1100 plus 1806 plus 470 plus 300 plus 35 890 35,890. Okay, yes, that will give us the total incomes of 39,566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid, meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number 4, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as the staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, we have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid. It's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these two coffee brand, Safi and Missouri. And because we captured those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Missouri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges, an amount of how much? An amount of 200. We have bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education, that is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that we have members education. Members education. Members education is a figure of 1,500. And then below that we have entertainment. Entertainment is a figure of 50. And then next and finally we have the legal fees. The legal fees, which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. So basically that is it, that what is required as far as that part was concerned, preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were six. So by recording those particular items of incomes and expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So we prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session. As far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment. investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 20 what? 6,550. Then below that we have receivables. We have receivables from members, which is a figure of 2960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. Amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other Coffee Brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 030. Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit. deposit, which is a figure of 64,650. Yes, and then from there we have various items of reserves, starting with just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you are told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We're going to compute that figure. And still we have appropriation account. Appropriation account, these accounts still, or these figures still need to be adjusted because what you're given there is the appropriation account at the start, which is what? Which is 50. To this, we should add the profit for the year. The profit for the year, remember, is 14,190. But equally, we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190. And we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,578 plus 64,650 plus 900,000. 900,000, which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record the liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information number 1, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee brand. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee brand is concerned. If you add those, the amount from Safi brand marketing account, Mzuri a brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee brand. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think with that what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent. Accrued rent, which is 470. Below that we have salary provision. Salary provision 4950. 4950. And then down there we have salary creditors. Salary creditors, which is a figure of 3410. And then we also have a bank OD, bank overdraft of 6150. 6150. Yes. So I think we have recorded all items of liabilities. None of the item which you have not recorded. None of the item which you have not recorded. Yes. So what we just need to do here is now we get the total. We get the total equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes. So that is giving us the same figure there as 10, 61, 330. 10, 61, 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. The items to be marked, but definitely that particular statement of financial position, as you can see, there are so many entries, so many what entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic. Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic on farm accounting or accounting for agriculture activities. And specifically, I want us to do an illustration question regarding preparation of financial statements. But before you do that, there is a question which I want to give as an assignment. And that is a question for April 2023, question number 5A. You check on that particular question, it was requiring you give some provisions of IS 41 as far as the measurement of agricultural produce are concerned, and also the disclosure requirement, the information to be disclosed if the fair value of agricultural produce cannot be ascertained reliably. So make sure you attempt that particular question. Equally, if you'll have a challenge in terms of answering that particular question there, I usually encourage my students to acquire this particular revision kit or this revision partner for Manifested publishers. You'll be able to get now the solution for the same at the end of that particular book. So therefore, make sure you look on that particular question there. Now, for the purpose of illustration regarding preparation of financial statements, I want us to look on a question which is here, and I can go through it. And the question reads: the trial balance was extracted from the books of David Wekesa, a farmer, as at 31st of October 2019. So we are given the inventory that is on 1st November 2018. This is now the opening inventory for dairy cattle, maize which is growing, dairy cattle feeds, fertilizer for maize, landed buildings, tractors, other cattle which are bulls, and then we have cats which is the net book value purchases for dairy cattle, fertilizer for maize, fertilizer for Napier grass, and then we have maize seeds, dairy cattle feeds. We have sales for milk, dry maize, green maize, dairy cattle, manure, and then we have crop expenses which include labor and other expenses, Napier grass, labor. We have the general expenses. Then we have trade payables. We have capital as all on 1st November 2018, cash at bank, and then we have dairy cattle expenses which include manure, not manure rather, we have medicine, we have labor, other expenses. Then we have some additional information. Number one, you're given the inventory as at 31st of October 2019, which included dry, that is dairy cattle, maize which is growing, other cattle which are bulls, dairy cattle feeds, and then we have fertilizer for planting maize. We have some additional information. Number two, we are told during the financial year which ended 31st of October 2019, the following distribution of farm produce were made. So we have the farm produce which were consumed by the family members, and then we have the milk delivered to relative, hotel. You have to remember how we treat such farm produce. One farm produce which are consumed by the family members. We said this is accounted for as sales and also accounted for as what? As drawings. And then we have the milk which is delivered to relative hotel. These like farm produce which are delivered or given to close relative. One, we account for that as sales, and two, we account for that as an expense in the general income statement. Number three, we are told manure valued at 600,000 removed from the cowshed and used in the maize plantation. This is what we refer to as the interdependence of department. Output from one department is an input in another department. So in this case, we said the producing department should account for that as sales, whereas the using department should account for that as purchases. Then we have the maize stock valued at 1.5 million used as daily cattle feed. The same case in the interdependence of department. The producing department account for that as sales. The using department account for that as purchases. Then we are told the cattle bulls are used for pulling carts. So basically carts majorly are used in the farm, and what that means that these particular bulls then are used in the farm. Any information relating to the bull basically will be recorded in maize, or not in the maize lather, in the crop revenue account. And then number 6, you are told depreciation is to be provided on tractors and carts on the reducing balance method at the rate of 25% and 12% per annum respectively. Number 7, you're told income tax is estimated at 3.6. So what you're required to do here, Roman 1, is we prepare revenue accounts. You can see not one account, but two accounts. But from the information, or actually from the information which you're given there, it is important for you to note that David Wekesa was involved like in two farming activities. You can see we are given some information regarding dairy cattle, meaning that David Wekesa was involved in dairy farming, and at the same time we are given information about maize which is growing, fertilizer for maize, and so on. So therefore we can say that David Wekesa was involved in some form of livestock keeping, which are dairy cows, and as a result of that we have said that you need to prepare a revenue account called livestock revenue account. Also, David Wekesa is involved in growing of maize. In such a case, you prepare something called the crop revenue account. So therefore, here we're going to prepare two accounts, the crop revenue account and the livestock revenue account. Roman 2, the income statement. This, what in other terms we have referred to as general income statement. And number 3, statement of financial position. So we start with the Roman 1 of that particular question, whereby we are required to prepare the revenue account for David Wekesa. So this is the revenue account. And we have said that the revenue account, this one is prepared using a T format. We prepare this using a T format. This will be the debit side. Whereas this is the credit side. And this particular account will be having two sides. This is the credit, this is the debit. And then we prepare those two revenue accounts concurrently. We have now the crop livestock account. That is the crop revenue account and livestock revenue account. In the same case on the debit side, livestock revenue account and the crop revenue account. The livestock and the crop revenue account. Then the other thing which is important for you to recall here is that in preparing this particular account, we have said on the credit side we record two items. We record the sales and also the opening inventory. On the debit side we record three items: the opening inventory, purchases, and also what what we refer to as the expenses, specifically relating to crop and also to livestock. So let's start by recording the sales, and for sales we are given information as far as that is concerned in the trial balance. So we just need to record the sales given here. So we are given the sales one of milk. We are given the sales of milk. So basically milk, this is from dairy cattle. So basically dairy cattle, these are livestock. So therefore that one we record it in the livestock revenue account. And also important for us to note here that all our figures are in thousands of shillings. All our figures will be in thousands of shillings. Will be in thousands of shillings. So then from there we also have the sale of dry maize. Maize is a form of a crop that go to the crop revenue account. And then we also have a sale of green maize, which is still a form of a crop that go to the crop revenue account. Then we also have a sale of dairy cattle. Dairy cattle, these are livestock. These go to the livestock revenue account, which is a figure of 81. And then from there we also have the sale of what? Of manure. Basically manure comes from what? From livestock, from dairy cows. And that is an amount of what? 3,000. So these are the various items of sales which are given. Then from there, we need to go back to the trial balance because there are other items which we also account for as what? As sales. Like maybe the farm produce which are consumed by the farm workers, by the family members, donated to close relative and so on. So let's go to note number 2. And in note number 2, first of all, we have the maize consumed by family members. Maize consumed by family members. So these we have said is accounted for as sales, and basically these are crops. So that will go to the crop revenue account. We also have milk delivered to relative hotel. Milk to relative hotel. This is also accounted for as sales. As far as the livestock is concerned, this is the agricultural produce from the dairy cows. That is an amount of what? Of 4320. Yes. So we have that. And then note number 3 and 4, we have interdependence of department. So number 1, we have the manure which was valued at 600,000, removed from the cowshed used in the maize plantation. We have said that the producing department now, which is the livestock, will basically account for that as what? As sales. So manure used in maize plantation. So that is sales as far as the livestock is concerned. And that is a figure of 600. And then we also have maize stock. Maize stock used as feeds or used as dairy feeds. So that maize stock is a form of came from the farm. The farming or the crop farming or the maize farming will account for that as what? As sales. That is an amount of what? Of 15. So I think that's what we have. Then note number 5, 6, 7 will not affect our sales. So therefore, those are, I think, additional items which you're going to account for as what? As the sales. 1, we have seen number 2, the maize consumed by the family members. That is accounted for as sales in the revenue account. Number 4, maize stock valued at 1.5, used to feed the dairy cows. So basically the maize stock come from the farm. That is what? Okay, yes, that will be accounted for as what? As the sales here. As the sales. And then we also have now the manure removed from the cow shed. Yes, so I think that treatment is okay. That treatment is okay. Used in the maize plantation. And also, yes. So then from there, the next item we need to record on this side is the closing inventory. Because I've said in the revenue account, we record 2 items on the credit side. The sales and also the closing inventory. Now for the closing inventory, this one is given in the additional information number 1. So for those particular items, we just need to copy them the way they are, no adjustment. So we have crossing inventory of dairy cattle. Dairy cattle, these are livestock that go to the livestock revenue account. We have crossing inventory of maize which was growing. Maize is a form of a crop that go to the crop revenue account. And then we have a crossing inventory of other cattle, which are bulls. There is some information which are given in note number Note number 5, whereby we are told these bulls are used in pulling carts. Carts mostly will be used in the farm. So therefore, these bulls are used in the farm, and that's the importance of that particular point number 5. So these will go to crop revenue account. And then from there we have crossing inventory for dairy cattle feeds. Dairy cattle feeds. So that got to the livestock revenue account, a figure of 1620. And then we have the crossing inventory for fertilizer for growing maize. Fertilizer for growing what? For growing maize. For growing maize. That automatically got to the what? To the crop revenue account, which is a figure of 1080. So those are the various items of crossing inventory we have. They are 5 items: dairy cattle, growing maize, and then we have dairy cattle, we have dairy cattle feeds, and then we have fertilizer for growing what? For growing maize. So that's what we record on the credit side. And then on the debit side, we record 3 items: the opening inventory. Then I've said we also record purchases and the expenses specifically relating to crop and also what? Livestock. So for this opening inventory, this one is given in the trial balance. So it's just a matter of transferring those particular figures here. And that is the first item in the trial balance. We have the opening inventory for dairy cattle. That go to the livestock revenue account, 54,900. Then we have opening inventory for growing maize. That got to the crop revenue account, 36. And then we have dairy cattle feeds. That got to the livestock revenue account, 2520. And then we have fertilizer. This fertilizer is for growing maize. So that got to the crop revenue account, 1980. So those are the various items of opening inventory. Then the other item which we also record on this side are purchases. First of all, we have the purchases in the trial balance. We have purchases of dairy cattle. Automatically that got to what? That will go to the livestock revenue account, 10,440. We have purchases for fertilizer. So some of the fertilizer is for maize, meaning that will go to the crop revenue account, which is a figure of 2160. We also have fertilizer for napier grass. We know that napier grass, this is for feeding the dairy cows. So that will go to the livestock revenue account. And then we have purchases for maize seeds. Maize seeds that go to the crop revenue account, which is a figure of 1080. And then we also have purchases of dairy cattle feeds. Dairy cattle feeds, which is a figure of what? Of 6120. Yes, so those are the various items of purchases given in the trial balance: 10,440 for dairy cattle, fertilizer 2160 for maize, for napier grass 4,000, 1080, which is maize seeds, and then daily cattle feed 61 what 20. Yes, so those are the items of purchases. But equally, in the additional information, we have some items of purchases, and basically what you check in the additional information is interdependence of departments. So in our case, we know note 3 and note 4, we are given information about interdependence of department. Remember, we have said this whereby output from one department is the input to the other. We have said the producing department will account for that as sales, but now the using department will account for that as what? Purchases. So let's go to note number 3. That manure which was removed from the cow shed and used in the maize plantation will be accounted for as purchases here. So we have what? We have the manure which was used in the maize plantation. Which was used in the maize what? Plantation. Which department will account for that as purchases? It is the maize farming or the crop farming. Whereas now we have seen that the producing department, which is now the dairy farming, account for that as sales. Then number 4, we have maize stock. Which is used as dairy cattle feeds. So maize stock come from the farm. This will account for that as sales. The maize farming department will account for that as what? Or in the crop revenue account, we account for that as sales. Whereas now the using department, the consuming department, which is dairy farming, will account for that as what? As purchases. As what? Purchases. So I think those are now the 2 additional items of purchases which we have. And finally, what we record on these in this account on the debit side are expenses. Specifically relating to crop and livestock. Remember, the expenses which you record here are the specific, not the general expenses. So which expenses do we have here in the trial balance? Let's go through the trial balance. We see which expenses we have. Maybe starting up there, we have inventory. The first item in the trial balance, it is inventory. Below that, we have lard, tractor, other cattle, cats. All those are assets. Purchases, we have dealt with that. We have dealt with the sales, and then we have the crop expenses. These are crop expenses, and these we have labor and other expenses, and these expenses we are told relate to crop. So therefore, we record that in the crop revenue account, a figure of 6480 and a figure of 720. Okay, so then from there we have napier grass labor. So basically we know napier grass is for feeding what? The dairy cows. So this is an expense relating to livestock. Napier grass labor that go to the livestock revenue account, and that is a figure of what? A figure of 1,000. And then from there we have now the general expenses. General expenses, these will go now to the general income statement. We'll go to the general income what? To the general income statement. From there we have payables, capital, cash at bank. Then we have dairy cattle expenses. Dairy cattle expenses. Dairy cattle expenses are expenses specifically relating to livestock. So we have number 1, medicine, which is a figure of 1080. We also have labor, which is a figure of what? Of 9480, and then we have other expenses. Which is a figure of what? Of 1440. Yes. So those are the various items of expenses, or the specific expenses which we have. So basically what we need to do is now we balance our revenue account so that we can be able to determine the profit or loss of each department, of each what? Department. So let's start by balancing the crop revenue account. And what we need to do is to get the total on both the debit and what? The credit side. So we start by getting the total on the debit. So let's start by getting the total on the debit side. So we have a figure of what? A figure of 3600. Then we have another figure for 1980 plus 2160 plus 1080 plus 600 plus 6480 plus 720. 720. So the total on the debit is equal to 620. What about the total on the credit? So we have 36,000 plus 11,340 plus 1080 plus 1,500 plus 2,700 plus 5,400 plus 1080. Yes, that will give us 59,100. So out of these particular two totals, we pick the one which is higher than the other, which is 59,100, and we record it here in our totals on both sides. On both sides, both the debit and the credit side. So we know that once we add all these, it will give us now 59,100. But now if we add what we have on the debit, is not coming to that, but rather it is coming to 16,620. So the difference, which is 42,480, 42,480, this is now the profit from that department. So from that department of crop farming, we can say Wekesa had a profit. So we do the same. We balance now the other account, the other revenue account, that is livestock. So let's first of all get the total on the debit side, 54,900 plus 25,20 plus 10,440 plus 4,000 plus 61,20 plus 1,500 plus 1,000 plus 1080 plus 9480 plus 1440. So that is giving us 92,480. And then let's get the total on the debit side. Sorry, on the credit side, we have 27,360 plus 8,100 plus 3,000 plus 4320 plus 600 plus 54,000 plus 1620. Okay, so let's take that again. Yeah, it is coming to 99,000. 99,000. It's okay. 99,000. So basically from that, the amount which is more is 99,000. We record it on both sides. 99,000. 99,000. But I think we can just confirm that. We can just confirm that for accuracy purpose. Can just confirm that. Is coming to 99,000. So the difference between the two now minus 92,480. So it's coming to 6520. So these whatever you have here, this is basically now the profit for the year from now those particular two what? From those two departments. So basically that question was given how many marks? 6. So these are the items generally which are marked. If you are able to record now the sales and also the closing inventory on this side, and also in the correct revenue account, so basically you get now a mark. You get a mark. You can see these are questions with so many entries. So by doing that, you get now your 6 what? Your 6 marks. So then from there, let's proceed and prepare now the income statement. In part A, not Patel, other Roman 1 of that particular question. Let's move to Roman 2, whereby we require to prepare now the income statement of David Wekesa, which is for the year which ended 31st of October 2019. 31st of October 2019. So this one is quite simple because we said that this one is prepared now to ascertain the entire the performance of the entire business of Wekesa. It's not prepared to ascertain the performance of each department, but prepared to ascertain the performance of the entire farming business undertaken by David Wekesa. And therefore, we have said in terms of how we prepare this, we take the incomes of David Wekesa from his farm, and then we less all what? The expenses. So what we start with here are the incomes, and basically I've said always we start from this we start with this particular profit from these two departments. So we have the profit from the crop revenue account and also from the livestock revenue account. So we have profit from the crop revenue account of 42,480, from livestock 6520. Yes, and then out to this we add other incomes. So what you need to check is whether David had any other income. You go back to the trial balance and basically check the items on the credit side of the trial balance. And I think up there I can see we have what, or basically on the credit side I think we have sales, which you have already considered as an income, and then payables, capital. None of those items is an income. So mean that David didn't have any other source of what? Income. So let's add the two figures so that we can get the total income of David. Okay, this will give us a total figure of what? A total figure of 49. And then to this, or basically this is now the total income. So to this, we proceed and we less what? We less the expenses, and the expenses which we have, we deduct here are the general, the expenses not relating to these farming activities, not relating to crop farming, not relating to livestock, but these are the general expenses which are incurred. Maybe you can start from the additional information. In the additional information number 1, we have closing inventory. Additional information number 2, we have this particular milk which is delivered to relative hotel, milk delivered to relative hotel. Essentially what I've said is that any farm produce which is like donated, which is given free of charge, is accounted for as an expense here. But now that particular maize which is consumed by the family members, we say it is accounted for as sales here, and then as what? As drawings. So then we have note number 3, 4, 5. Okay, those will not affect this general income statement. And then we have now note number 6, we have depreciation on tractors, which is now at the rate of 25%, and also depreciation on carts. Carts, these one are like mkokoteni, which are used in the farm. So basically we need to compute now their depreciation, and we are told this depreciation is on the net book value. So what is the net book value of these two assets? So the net book value of tractors is what is 32,400. 32,400, and for the other one is 6,000. So this one we can say just that is 600. That is 600, and 12% of 6,000. Okay, let me confirm that. It should be 12% of 6,000. Yes, that will not be 36, but rather it will be 720. So this will be 720. What about 25% of 32,400? This is 8,100. Yes, so that depreciation is a general expense. Okay, so then from there we have number 7. Number 7 is about tax. It's still an expense, but first of all, we have to compute the profit before tax. Then we proceed and less what? Tax. So what then we need to do, can we go back to the trial balance? We check whether we have any other general expense. And I think we only have one general expense, which in the trial balance is given, is referred to as the general expense. The general expense, or the general expenses, which is a figure of 800. So we need to get the total expenses, and then we less that from our total income. So we have 4320 plus 8100 plus 720 plus 10800. That will give us a total of 23,940. So we less that from our total up there, and we get a figure of 25,060. So this one we refer to it as profit before tax. Remember, in the additional information number 7, we are told we are given estimated income tax. So what we need to do, we less the estimated income tax, which is a figure of what? Of 3,600. And then we will get the profit for the year. The profit for the year. Profit for the year. This one will be how much? We have 25,060 minus 3,600. Yes, that will give us a figure of 21,640. So that is it. That what was required as far as that Roman 2 is concerned, and the marks are located. There were 6. So definitely the items which were marked is what we have there. So by doing that, you get now your 3 marks. So finally, Roman 3, we are required to prepare the statement of financial position, statement of financial position as at 31st October 2019. So this one is a statement of assets, liabilities, and what? And capital. So we start by recording assets. Specifically, we record always. First of all, we record non-current assets. So for non-current asset, I think we have a number of them in the trial balance. You have to record that all assets have a debit balance, and I think we can start from where we have land and buildings. Land and buildings. So for added buildings, I hope you can see they are not depreciated. So for the value for added buildings remain the same as 90,000. Then below that we have tractors. We have tractors. Tractors, we are given their net book value as 32,400. But these tractors during the year they depreciated. They lost a value of 81. So we have to less that depreciation there, so that we get their net book value at the end. We are going to compute that. And then from there we have other cattle, which are bulls. So remember, these are still assets. Specifically under IAS 41, we refer to them as biological assets. Biological assets. So they have a value of 6,000. And then from there we have cats. Cats, we are given the value as what? As we are given the value as what? As 3,000. So meaning that there is something we need to correct here. This value is not 6,000, but rather it was 3,000. 3,000. So let's make that small change here. We took the wrong figure, so meaning that we have 12% of 3,000. 3,000. So that will be, this will be 360. 360. So we can correct this, which will be 23,940 minus 720 plus 360. That will be 23,580. 580. So we less it from that figure up there, 49,000. So which will give us 25 for 20, and then minus 3,600. Yes, so this will be 21,820. Yes, so that should be the correct thing. So I've taken the wrong figure for cuts there, 6,000 instead of 3,000. So that will be cuts 3,000. So we less their depreciation here of 360. 360. Okay, so maybe you can just confirm whether we have any other item of non-current assets. Any other item of non-current asset in the trial balance, and I don't think so. So let's get now get the final figures here for these two assets, starting with the tractors. Tractors, we have 32. We have 32,400 minus 8,100, which will give us what? Which will give us 24,300. And then we have cuts. We have 3,000 minus 320, which will give us what? 2640. 26 what? 40. 2640. Okay, I'm trying to counter check whether we have any other item. Any other item of non-current asset? I don't think so. Yes, so next we record current assets. We record current assets. So for current assets, what do we have here? In the trial balance, we check the items on the debit side. What can I see? I can see cash at bank. Cash at bank, which is a figure of 15,300. 15,300. Yes, I think that is the only item we have in the trial balance. But now in the additional information number 1, we have the crossing inventory. Crossing inventory. So we have various items of crossing inventory, which include daily cattle. Daily cattle having a value of 54,000. We then have growing maize having a value of 27. We have other cattle, which are bulls, having a value of what? A value of 54. And then we have daily cattle feeds. Daily cattle feeds having a value of 1620. And then we have fertilizer for planting maize, which is 10 what? 1080. So those are the various items of crossing inventory we have in note number 1. Note number 1080, 16, 20, 54, 27, 54,000. Okay, number 2, number 3, number 4. Yes, so we don't have any other item of current assets. So what we need to do is to get the total assets. Let's get the total asset. We add all these particular assets we have here, starting from what we have here at an non-current asset. We have 90,000. We have the other item 24,3, 6,000 plus 2640 plus 15,300, 300 plus 54,000 plus 27 plus 54 plus 1620 plus 1080. Yes, that will give us a total of 203,040. And then from there we record the financials, which include capital and what? Liabilities. So we start by recording capital, which is the first, actually not the first, but we have it in the trial balance as a figure of what? We have capital in the trial balance as a figure of 163,080. So to this, what do we add? We add the profit for the year. The profit for the year from the income statement, this one, which is 18 what? That is 21,820. And then to this, because this is a sole proprietorship business of David Wekesa, we less any drawings. And in the trial balance, we don't have drawings, but we have the information we have in note number 2 about the maize consumed by family members. We have said any farm produce consumed by the family member, we account for that as sales in the revenue account, and then we account for it as drawings here. So 1080. So then what do we get? We get the net capital at the end of the year. The net capital at the end of what? Of the year. So we have capital which is 163,080 plus 21,820 minus 1080, which will give us 183,820. And then to this we add liabilities. So always we start with the non-current liabilities. Because these are a sole proprietorship business, the only non-current liability which a sole proprietor may be having is a bank loan. Do we have a bank loan in this question here? No. So meaning that here we don't have any non-current liability. Finally, we record the current liabilities. For current liabilities, let's start with the what we have in the additional information. Additional information number 7, where we have the income tax. That income tax was not yet paid, and that's why it is given as part of the additional information. If it had already been paid, then it should be part of the trial balance. So take into account it had not been paid, it will be one of the current liability. And then in the trial balance, we have the trade payables. We have trade payables of 15,620. Do we have anything else? Do we have anything else? No. So what we need to do here is we get now the total. We get the total. We get total, capital, and liabilities. Total, capital, and liabilities. So we add those 3 items. 183,820 plus 3600 plus 15,620. And that is giving us the same figure of 203,040 as what we have there, is what we have there. So that is it. That basically what was required in that particular part of that particular question. And equally the marks which were located there were how many marks? Were 3 marks. So those are the items now which were giving those 3 what? Those 3 marks. So that basically brings us now to the end of that particular topic relating to agriculture or accounting for agriculture activities, or accounting for farming activities. We have been able to discuss a number of issues. We have discussed what is biological asset, the recognition criteria, the initial subsequent measurement, and also we have looked on the financial statements prepared by an entity or basically a company involved in some farming or agriculture activities. Equally, you have looked on an illustration, and also there is another question which I've given as an assignment. Make sure that question which I've given as an assignment you attempted. So we stop at that point. See you in the next class as we discuss the next subtopic.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I'm a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to discuss about portfolio management. Focus is on contemporary issues and emerging trends. Today, we are going to narrow down that discussion and talk about stock lending. So we can provide a description on what stock lending is, and we say stock lending, also called securities lending, is the lending of securities by one party to another. That is what stock or securities lending is. Also called securities lending is the lending of securities by one party to another. We proceed on and say that the terms of the loan will be governed by a securities lending agreement, We can just remove that dot over there, securities lending agreement, which requires that the borrower provides the lender with collateral. In the form of cash or non-cash securities. In the form of cash or non-cash securities of value, non-cash securities of value, cash or non-cash securities of value equal to or greater than, the loaned security, move on this other side, loaned security equal to or greater than the loaned security plus an agreed margin. Full stop there. So we are saying stock lending, also called securities lending, is the lending of securities by one party to another. the terms of the loan will be governed. The terms of the loan will be governed by a securities lending agreement, which requires that the borrower provides the lender with collateral in the form of cash or non-cash securities of value equal to or greater than the loaned security plus an agreed margin. So that is what we're saying stock lending is. I will shortly demonstrate what stock lending is using a diagram. So we can, before we draw the diagram, I can say that the agreement is enforceable. The agreement is enforceable. It's enforceable under relevant law. Under relevant law. Relevant law, which is often specified. Which is often specified. It's often specified in the agreement. In the agreement. So we're saying that the agreement is enforceable under relevant law, which is often specified in the agreement. So this is the way securities lending or stock lending occurs. So on one side over here, we have what we call the lender, and on this other side over here, we have what is called the borrower. So borrower. And here we have the lender. Like that. On this other side, we have the investment. Investment. I have another rectangle right over here called the investment. Investment. The investment. Now we're saying that the special arrows that highlight what securities lending are shown to you there. And I'll be able to label them in a bit. So the lender provides securities to the borrower. So here we're saying securities. Provides securities to the borrower, and the borrower is expected to provide collateral. Collateral. Collateral is what we can be able to say as security, as a security. So what the lender does is that the lender then invests, rather using this arrow over here, sorry, not this one is moving up over here. The collateral is then provided for investment, so collateral, like that. And then what comes out of that is reinvestment income. So over here we can say reinvestment income. Reinvestment income, like that. So this is the simplest way I can be able to explain to you what securities lending is all about. The lender provides securities to the borrower. The borrower is expected to provide collateral, which in turn the lender invests that collateral there, and then they actually get reinvestment income from that element of investment right there. So moving over on this other side, we look at the benefits and disbenefits of securities lending or stock lending. We can say benefits of securities lending. Benefits of securities lending. Lenders. Point. Over here we say ability to earn income through fees charged to the borrower continuously. And then we also say that to the lender, it provides them with an ability to have diversification. So diversification. So the lender has an additional option to invest or to earn income by lending out the security to the borrower. From the borrower's point, the benefit or the major benefit is that there are more options available to take. There are more options available to take additional securities. There are more options available to take additional securities. Then we can also say allows them to take positions in short selling. Allows them to take positions in short selling. That. Then now we go to disadvantages. Let me try and see if there's another advantage over here from the borrower's point. Increases liquidity. It provides for increased liquidity. Within the market so as to tighten spreads. Within the market so as to tighten spreads. Which is good for market participants to earn returns. Which is good for market participants to earn returns. So here, let's look at the disadvantages. So disadvantages, these benefits of securities lending, Then we can say lender's point. We can say the value of the collateral decreases. If the value of the collateral decreases, below the cost, the lender is disadvantaged. Another disadvantage is that if is disadvantaged there as well, the lender, rather the borrower, may become insolvent. The borrower may become insolvent, leading to default risk, leading to default risk, which may affect the operation of the lender, the operations of the lender. Then, from the borrower's standpoint, if the value of the collateral increases, if the value of the collateral increases above the cost, if the value of the collateral increases above the cost, the borrower is disadvantaged. The borrower will be disadvantaged. So we are saying that if the value of the collateral decreases below the cost, the lender is disadvantaged. As well, the borrower may be more insolvent, leading to default risk. From the borrower's point, ladies and gentlemen, if the value of the collateral increases above the cost, the borrower will be disadvantaged there. And if that happens, then of course it means that the borrower is going to really spend much more repaying the debt that they actually took in form of securities right over here. So this diagram right over here, ladies and gentlemen, I can be able to explain to you that is a rather simple diagram, but if you look at it from the lender's point of view, the benefits and disbenefits, the borrower's point of view, the benefits and disbenefits are pretty straightforward. So this brings us to the end of today's lesson, ladies and gentlemen. I hope you've enjoyed it, and I will be able to give you an assignment. I can do it on this side. Explain the benefits and disbenefits of securities lending from both the lender's and the borrower's standpoint. Thank you for being with Manifested Publishers. Be blessed.
Hi students, welcome back to Manifested online classes. So in this session, I want us to continue with the risk accounting, and specifically I want us to look on how risks are accounted for by the lessor. So remember, in our previous classes, we have already looked on how risks are accounted for by the lessee, and equally we have looked on an illustration as far as that is concerned. So in this session, I want us to look on how the risks are accounted for by the owner of the asset, or basically the person who is called the lessor. Now, according to IFRS 16, the lessor, the owner of the asset, should basically determine whether the risk is an operating risk or a finance risk. So mean that the owner of the asset, the lessor, is permitted to classify a risk as a finance or an operating risk. Remember what we said as far as risk accounting by the lessee is concerned. We say that the lessee is totally prohibited from classifying the asset, from classifying the risk as an operating or a finance risk. But the owner of the asset, or basically the lessor, should be able to determine whether the risk is actually a finance or an operating risk. And we're going to look on some of the criteria which may be used by the owner of the asset in terms of determining whether the risk is is an operating or a finance risk. But first of all, here we can say that the lessor, you have to record that this is the owner of the asset. Owner of the asset should determine. Yes, so in this case, we are saying that the owner of the asset here should determine whether there is an operating or a finance what? Or a finance risk. Now, in this case, whenever the lessee or basically the owner of the asset is doing that, is determining whether there is an operating or a finance risk, there are a number of criteria which are used in terms of doing that. So therefore, you can say that IFRS 16 IFRS 16 gives the situations which can make a risk. So therefore, IFRS 16 here gives a number of situations which can make a risk now to be classified as a finance what? A risk. Now, which are those situations which can make a risk to be classified as a finance risk and not an operating risk? One of it is what referred as a transfer of ownership. Transfer of ownership. Basically, what this means is that if the ownership of the asset, or in other terms, the legal title of the asset, will be transferred from the owner, that is now the lessor, to the person who is called the lessee, that lease should always be classified as what? As a finance risk. But on the other hand, if the ownership of the asset, if the legal title will not be transferred from the owner of the asset or the lessor to the lessee, then that should be classified as an operating what? Risk. So that is one of the criteria which may be used in terms of determining whether the risk is an operating or what? Finance. Number two is something called the option to purchase, option to purchase, or option to buy. Option to purchase or option to buy. What this means is that if the lessee, the person who has leased the asset, has been given the option to buy or to purchase the asset at the end of the lease, then that lease always should be classified as a finance lease. But if the lessee has not been given that particular option to buy the asset at the end of the lease, then always that is an operating what? An operating risk. So the other situation or the other criteria which may be used in terms of classifying the risk as a finance or operating risk is that a risk is basically said to be a finance risk if the risk term is for a major part of economic life of an asset, So basically what that means is that if the risk term, remember when talk about the risk term, we are talking of the period of the risk, the period the risk will take place, or basically the period within which now the lessee is supposed now to do what? To use the asset. So if that particular risk term is for a major part of the economic life of the asset, then that should be classified as a finance what? It is. And actually in this case, we say that the risk is for a major part of the economic life of the asset if the risk term is 75% or more, 75% or more of the economic life of the asset. For instance, let's assume that the lessee has leased an asset for a period of like 8 years. So mean that the lease term in this case are 8 years, and then we are told that the economic life of the asset, in this case are 10 years, So what we do in this case, we take now the lease term which are 8 years, then express that as a percentage of the economic life of the asset. The economic life of the asset in our case here are 10 years, and then multiply that with 100. So in this case, we are going to get 80%. So because you have gotten 80%, which is more than 75%, then we say that the lease term, which is a period of 8 years, is for a major part of the economic life of the asset. If that is the case, then that lease is classified as a finance what? Risk. But if you get a percentage here which is less than 75%, then that should be classified as a finance what? Risk. Now, the other situation which can make a risk to be classified as a finance risk, number 4 here, Number 4 is if the present value of the minimum lease rentals, present value of minimum lease rentals at inception date of the lease, inception date of the lease. So therefore, the other situation which will make a lease to be classified as a finance lease is whereby the present value of the minimum lease rentals at the inception date, at the commencement date of the lease, is equal to the fair value of the leased what? Asset. The fair value of the leased asset. So if the two are basically the same, present value of the minimum lease rentals and the fair value of the leased asset are the same at the inception date of the lease, that will make now the lease to be classified as what? As a finance lease. So the last situation which will make the lease to be classified as a finance lease and not an operating lease, number 5, is where the leased asset is of a specialized nature, So we say that a lease will be classified as a finance lease if the leased asset is of a specialized nature such that it is only the lessee who can be able to use that particular asset without major what? Modification, without doing some major modification as far as the asset are what? Are concerned. So therefore, whenever now the owner of the asset or basically the lessor is determining whether the lease is an operating lease or basically an operating or a finance lease, these are some of the factors which now need to be considered by who? The owner of the asset or basically the lessor. And therefore, after looking on those particular criteria, I want us to proceed and look on how these two types of leases, the finance lease and also the operating lease, are supposed to be accounted for in the books of account of who? In the books of account of the owner or basically the lessor. So therefore, we start by looking on how operating lease is accounted for. So we can look on accounting for operating leases. Accounting for operating leases. So in this case, first of all, an operating or a lease will be regarded to be an operating lease if such a lease do not meet most of these particular what? Criteria. For example, the ownership of the asset will not be transferred to the lessee at the end of the lease. Number 2, the lessee has not been given the option to purchase or buy now the leased asset, and also the lease term is not for major part of the economic life of what? Of the asset. So if most of these particular criteria have not been met, then that will be classified as an operating what? Lease. Now, how should an operating lease then be accounted for by the owner or basically by the lessor? So in this case, what the lessor should account for here is the rent now which is receiving from now the various lessees or from the lessee, and that rent which is being received by the owner or the lessor should be recognized as part of the other incomes in the income what? Statement. So therefore, here we can say that the lessor should recognize rent received as a part of other incomes, in the income what? Statement. In the income what? Statement. So that particular rent which is being received by the owner of the asset is what should be recognized as part of the other incomes in the income statement. It is also obvious that the owner of the asset here will still continue recognizing the asset in his books of account, because in this case, what we said initially is that under operating lease, the risk and also the rewards associated with the asset will not be transferred to the lessee, will not be transferred to who? To the lessee. So therefore, it's also important for us to note that the lessor will recognize, will recognize the least asset, in the statement of financial position. So in this case now, the asset which has been listed will still be recognized in the statement of financial position, simply because the risk and also the rewards associated with that particular asset have not been transferred, to who? To the lessee. So therefore, in terms of how we account for the operating risk is just simple and straightforward. What the lessor will be accounting for in his books of account is the rent received, and which should be recognized as part of the other incomes in the income statement. And two, the lessor will still continue recognizing the asset in his statement of financial position and be depreciated in the normal way. Be depreciated on the in the normal way, simply because the risk and also the rewards associated with that particular asset has not been transferred to the lessee. Then from there, let's look on how we account for the finance risk. Accounting for finance risk. So first of all, you have to remember, we have said that a finance risk is basically that particular risk which will have met most of those particular criteria. One, under this particular risk here, the ownership of the asset will be transferred to the person who is called the lessee at the end of the lease. Number two is that the lessee has been given the option or basically the right to do what? To purchase or buy the asset. And number three is that the lease term here is for a major part of the economic life of the asset. So if you express now the lease term as a percentage of the economic life of the asset, you'll get a percentage of you'll get a percentage which is more than 75% or basically 75% or more, or more. Or on the other hand, we have said that if the present value of the minimum lease rentals at the inception date of the lease is equal to the fair value of the leased asset, that will also make now that particular lease now to be classified as a finance risk. You also have to remember what we said, that under the finance risk, the owner of the asset will transfer substantially all the risk and rewards associated with the asset to the person who is called the lessee. And here, because the risk and rewards associated with the asset are transferred to the person who is called the lessee, what the owner of the asset, what the lessor should do, first of all, is to recognize that particular asset in his books of what? Of account. So therefore, here we can say that the lessor Yes, so in this case, the lessor will basically, the owner of the asset will do what? Will recognize the asset in his or her books of account. To recognize, basically what that means is that that particular asset which has been leased out to the lessee will no longer be recorded or will no longer be appearing in the books of account of the lessor, meaning that the asset has been recognized. And then from there, the lessor will continue and recognize something called the net investment in the lease. The net investment in what? In the lease. So how do we determine this net investment in the lease? Net investment in the lease. So we can say the net investment in the lease, net investment in the lease, net investment in the lease, this is determined by adding two items. One, we take something called the present value of the lease payment receivable, lease payment receivable by the lessor. So in this case, if you own an asset, you have leased out that particular asset under a finance lease, automatically you'll be receiving some rent from the lessee. So get the present value of the lease payment receivable by the lessor, and then to this we add the present value of the unguaranteed residue value. Unguaranteed residue value. I'll be able to explain what we mean by the unguaranteed residue value. And whatever we get here is what we refer as the net investment in what? In the risk. And this, what the owner of the asset, or basically the lessor, should be able to recognize under what we refer as what? A finance risk. Now, first of all, what do you mean by the unguaranteed residue value? Remember, there is something we have mentioned here, that under finance risk, always the lessee, the person who has raised the asset, will be given the option, will be given the right to buy the asset at the end of the risk. Let's assume that we have a risk here, which is for a period of 3 years. A risk for a period of 3 years, and the lessee has been given the right to buy the asset at the end of the lease, and when buying that particular asset, the two parties have agreed that the lessee will pay an amount of shillings 50,000. So this particular amount of shillings 50,000, we refer to it as a guaranteed residue amount. Guaranteed residue amount. Why do we refer to it as a guaranteed residue amount? Is because at the end of the 3rd year, when the lessee exercise the right to buy that particular asset, then he will be expected to pay an amount of how much? 50,000. So that amount which the lessee will have to pay, we refer to it as the guaranteed residue amount. Guaranteed residue amount. But now let's assume that the owner of this particular asset, that is now the lessor, expect that at the end of the lease, he will be able to sell this particular asset at a higher amount. So maybe the expectation of the owner of this particular asset is that at the end of the lease, he will be able to get another buyer who will buy that particular asset at an amount of how much? 80,000. Ordinarily, these two parties, that is the lessor and the lessee, will have agreed that if the owner of the asset, that is the lessor, can be able to get another third party who can be able to buy this particular asset at an amount which is higher than 50,000, then the owner of the asset, or basically the lessor, can go ahead and sell that particular asset to that other third party. So therefore, if the owner therefore expects that at the end of the lease, he will be able to get to sell that particular asset at an amount of 80,000. Now the amount which is above this 50,000, then we refer to it as unguaranteed residue amount, because the owner of the asset is not very sure that that particular third party will be able to come in and basically buy that particular asset at an amount of how much? 80,000. So therefore, in our case here, the unguaranteed residue amount from this small illustration will be 80,000, the amount which the owner of the asset expects to sell the asset at the end of the lease, minus the amount of money which the lessee will have to pay when buying that particular asset at the end of the lease. So that 30,000, we refer to it as unguaranteed residue amount. The owner of the asset is not very sure, is not assured by the lessee that he will be able to get this particular amount of what? 30,000. So therefore, in determining that particular net investment in the lease, one, we get the present value of the lease payment receivable by the lessor, that is the owner of the asset, and always this include the guaranteed residue amount. The guaranteed residue what? Amount, and then to that we add the present value of the unguaranteed residue amount. Whatever you get there is known as the net investment in the lease, and this should be recognized in the books of account of the owner of the asset, or basically the lessor, as an asset. As what? As an asset, and then from there it should be amortized over the lease term. Over the lease what? A term. So therefore, that is how the finance lease should be accounted for by the owner of the asset, or basically by the lessor, whereby we have said the lessor one, we need to recognize that particular asset in his books of account simply because he has transferred the risk and rewards associated with the asset to the person who is called the lessee, and then he recognized something called the net investment in what? In the lease. And basically that's how we determine what? the net investment in the lease. So I want us to look on an illustration as far as this is concerned. We look on how we determine this particular net investment in what? In the lease. Yes, so we look on an illustration, and the illustration reads, we go through that illustration, and it reads, Aresa, or basically the owner of the asset, entered into a 3-year leasing agreement commencing on 1st of January 2013. At the terms of the lease, the lessee commit to pay shillings 80,000 per annum commencing on 31st of December 2023. And then you're told the residue guaranteed or the residue guarantee clause require the lessee to pay shillings 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than shillings 40,000. So basically what that means is that the lessee here has been given the option to buy the asset, and when buying the asset at the end of the lease, then he is expected to pay an amount of how much? Shillings 40,000. But in this case now, or the lessee will only be expected to pay this particular amount of money if now the owner of the asset, that is the lessor, cannot be able to get another person to buy the asset at a price which is higher than that. And then you're told the lessor, that is the owner of the asset, expect to sell the asset based on the current expectation for shillings 50,000 at the end of the lease. So the owner of the asset here expects that at the end of the lease, then he will be able to sell the asset at an amount of how much? 50,000. So we are told the interest rate implicit in the lease is 9.2%. Then what we are required is to show the net investment in the lease on 1st January 2013 to 31st of December 2015. 31st of December 2015 is the date when the lease is supposed to end, because in this case we are told in the first paragraph there that the lease is for a period of 3 years. So therefore, let's determine the net investment in the lease. So this now will be our solution in that particular illustration. So the first thing we need to determine here is the net investment in the lease. Net investment in the lease. Yes, so we determine the net investment in the lease at the commencement date of the lease. The commencement date of the lease in our case is 1st of January 2023. So how do we determine this? I've said to determine the net investment in the lease, basically we add 2 items. The present value of the lease payment receivable by the lessor, including the guaranteed what? Residue amount, and also the present value of what? The unguaranteed residue amount. For us to be able to compute this, maybe we can have a small summary here of what you are told in that particular question, so that you can be able to understand how we are computing this. We are told that this particular lease one is for a period of 3 years. So year 1, year 2, year what? Year 3. And that lease commenced on 1st of January 2013. This is now what we refer as the inception date of the lease, the date when the lease commenced. And then you are told under the terms of the lease, the lessee, the person who has leased that asset, commit to pay shillings 80,000 per annum commencing on 31st of December 2013. So the first rent here to be received by the owner of this asset will be received at the end of year 1, automatically the other one at the end of year 2, and the other one at the end of what? Year 3. So mean that this rent is payable at the end of each what? Year. And then you're told a residue guarantee clause requires the lessee to pay shillings 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than shillings 40,000. So basically what you are told here is that the lessee has been given the option to purchase or buy the asset at the end of the lease term, and in that case the lessee is expected to pay shillings what? 40,000 when buying that asset. This particular amount of money, which is to be paid by the lessee at the end of the lease term when buying the asset, then we have referred to this as a guaranteed residue amount. Guaranteed residue amount. And then in the other paragraph, you're told the lessor expect to sell the asset based on the current expectation for shillings 50,000 at the end of the lease. So meaning that the owner of the asset, we are told, at the end of the lease expect to sell the asset at an amount of how much? Shillings 50,000. Shillings 50 what? Thousand. So why are you given this particular amount here? You are given this particular amount for you to be able to determine what we refer to as the unguaranteed residue amount. The unguaranteed residue amount in this case will be equal to what? To 50,000, the amount which the owner of the asset expect to sell the asset at the end of the lease, which is 50,000, minus the guaranteed residue amount. So in this case, we are going to get now the unguaranteed residue amount of how much? Of 10,000. So why do we refer to it as unguaranteed residue amount? Is because the owner of the asset, or basically the lessor, is not assured by the lessee of this particular amount of 10,000. Or in other terms, we say that the owner of the asset is not assured by any party that you'll be able to get this particular amount of 10,000 at the end of the lease period, at the end of the lease what? Term. So having that, we can proceed and we determine this. Remember, I've said this is equal to the present value of the lease payment receivable, including the guaranteed what? Residue amount. So therefore, the first thing we need to do here is to get the present value of this lease rental, lease payment receivable. So we get the present value of the lease payment receivable by the lessee, by the lessor, that is. So first of all, let's discount this lease rental receivable, which is an amount of 80,000, and this is an annuity because it is receivable annually. So we multiply that with the present value interest factor of annuity, and the rate which we are applying here will be 9.2%, which is now the interest rate implicit in the lease. So meaning that we multiply this with the present value interest factor at the rate of 9.2 for 3 what? Years. So this will be 1 point, or basically 1 minus 1.092 raised to power negative 3. Our nth here will be 3, and then divided by R, which is 0.09 what? 2. So this now will give us the present value of the minimum lease rentals, and also to this we need to include the present value of the guaranteed residue amount. The guaranteed residue amount in this case we have said is what? 40,000. Now this 40,000 will be received at the end of the third year. So therefore that is a lump sum. So how do we discount a lump sum? We take 40,000, we multiply that with the present value interest factor, which will be computed by taking 1 plus R, which is 0.92. We raise that to power negative n, which is 3, or basically negative 3. So that now will give us the present value of the lease payment what? Receivable by the lessor, and then finally to this we add the present value of unguaranteed residue what? Unguaranteed residue amount. In our case, we know that the unguaranteed residue amount is an amount of 10,000, which now is a lump sum, is an amount of money which the owner of the asset expects to receive at the end of the lease. So therefore, we multiply that with the present value interest factor, which is 1.092 raised to power negative what? 3, raised to power negative 3. So, and this now will give us what? The net investment in the lease at the inception date of the lease. So let's compute this. We start with this here. So we first of all compute this present value interest factor. So we have 1.09 raised to power negative 3, and then we deduct that from 1 divided by 0.092 times 80,000 times 80,000, which will give us 198, 101, 198, 101, and then we get now the present value of the guaranteed residue amount. So we have 1.09 raised to power negative 3 times 40,000, which will give us 887. And then finally we get the present value of the unguaranteed residue amount, which is 1.092 raised to power negative 3 times 10,000, so which will give us 76, 70 what? 9. So then what we need to do, we add all these particular figures, and then we will be able to get what? the net investment in the risk at the inception date of the risk. So we have 188, 101 plus 30, 887 plus 76, 79, and that will give us what? That will give us 36, 667, 6 what? 7. So what is this? This now the net investment in the risk at the inception date of what? The risk. At the inception date of what? Of the risk. So therefore, that's how we determine what we refer as the net investment in what? In the risk. And remember also what you have said is that other than the owner of the asset recognizing that net investment in the risk, he also needs to recognize that particular asset in his books of what? Of account. So therefore, that basically what you need to know as far as accounting for risks by the owner of the asset or basically by the lessor is concerned. And basically that brings us to the end of that subtopic on accounting for risks.
Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. Today we're going to study legal audit as a subtopic under the chapter on Introduction to Corporate Governance. In our last session we discussed the compliance obligations. Today we're moving on to legal audit. By the end of this lesson, you should be able to define legal audit, should also be able to explain the importance of or the objectives of legal audit. Legal audit. Remember in our last session we said that compliance is the process of adhering to rules, regulations, and laws. We also mentioned that a company should put in place a system to monitor and check if the company is adhering to rules, regulations, and laws. And legal audit then is defined as the inspecting or the inspection of the company's activities, transactions, and practices to establish their compliance to its constitution and with the applicable authorities. Legal audit is the process of inspecting the company's activities, transactions, and practices to establish if the company is adhering to laws, regulations, and rules that are applicable to the company. It can also be defined as the systematic review of the company's transactions, contracts, and practices to establish its legal status and identify the potential legal problems. It may also help minimize its legal liability. So the main purpose of legal audit is to help the company minimize risks and potential legal liabilities. It focuses on subjects like the form of business organization, the review of taxation law compliance, a review of intellectual property issues, use of internet, the human resources, among other areas, though legal audit covers such areas. So I've defined legal audit candidates as the inspection of the company's activities, the company's practices to establish their compliance to laws, regulations, and rules. It is the inspection of the company's activities, the company's transactions to establish compliance with laws, to establish compliance with laws. It is the inspection of the company's transaction to establish compliance. All right? It is the systematic review of the company's transactions. It is the systematic review of the company's transactions, the company's contracts and practices to establish its legal status and identify potential legal problems and help minimize its legal liability. So let's now study the objectives. What are the objectives of legal audit? Objectives of legal audit. Objectives of legal audit. Now, objective number one, candidates, is that legal audit promotes accountability. Promotes accountability. Legal audit does what? Promotes accountability. By doing what? By reporting deviations from violations of authorities so that corrective action may be taken by the company. Because when you are carrying out a legal audit, you on one hand have a list of the requirements, the legal requirements. Then you check if the company has complied, you tick, all right, with this one, complied. Number two, complied. Number three, not complied. So it's a systematic review of the transactions of the company. It does what? Promotes accountability. When review is carried out, when the activities are compared vis-a-vis the requirements, then it's possible to identify areas that have not been complied with. So the legal audit will identify deviations, and that promotes accountability. Two, identifies the company's legal liabilities. A legal audit can help identify a company's legal liabilities and risks beforehand. And risks beforehand. It helps, in other words, identify the potential liabilities and risks before they come up, all right? And if it's possible to identify legal liabilities and risks beforehand, then the company can come up with a way of averting potential lawsuits and penalties. And that is a sure way of saving the company's money in litigation costs and other unnecessary expenses. The third objective of a legal audit is that legal audit helps the company become or remain compliant. Helps the company remain compliant. It helps the company to remain compliant with the laws and policies that are put in place as it